네, 저희 본 행사 바로
So we are going to start the conference shortly, so please take your seat.
immediately, so could you please take your seat? Thank you. Well, Your Excellencies, distinguished guests, ladies and gentlemen, good afternoon, or good morning, or good evening, depending on where you're joining us online today. My name is Hemi Kim, and I'm a conference interpreter, and it's indeed my great honor and pleasure to serve as your MC today for this Jeonbuk International Finance Conference 2022, also known as JIFIC 2022, which is being held under the theme of the future of asset management and the role of regional finance. On behalf of our hosts, I would like to express my sincere gratitude and welcome to all of you who are joining us today, both online and offline. Well, the Jeonbuk International Finance Conference is co-hosted by Jeollabuk-do Provincial Government and the National Pension Service of the Republic of Korea, as well as the city of Jeonju. And this year, we are celebrating its 5th anniversary, which is serving as a precious platform where leaders in finance from home and abroad come together to assess the global financial markets in the age of great transformation, reflecting the economic and industrial trends that are changing rapidly. And this year, it also aims to discuss the future of asset management and the role of regional finance. We sincerely hope that all of our distinguished guests who are participating in this conference today will have a meaningful time with us and enjoy constructive discussions as well. For your information, please note that the Jeonbuk International Finance Conference 2022 is being broadcast live as we speak, and you can find the live broadcast link on the official website of JIFIC 2022 and the Genie Forum. So please join us online and stay tuned until the very end of our programs today, and we are very much looking forward to your proactive participation. So without further ado, let us begin JIFIC 2022 in earnest. Well, first of all, Mr. Robin Vince, President and Chief Executive Officer of BNY Mellon, has kindly sent us a congratulatory message to extend his congratulations on the launch of Jeonbuk International Finance Conference 2022. So without further ado, let's take a look.
Annyeong haseyo. I'm Robin Vince, Chief Executive Officer at BNY Mellon. It's great to join you today, although I'm sorry not to be with you in person in Jeonju. The city is fast becoming a local hub of talent and innovation, and I hope to visit soon. I want to begin by expressing my gratitude for our work with NPS. We're honored to be working with you to support Korea's capital markets and economic growth. While we're facing a dynamic moment in global markets, driven by several interrelated factors, including geopolitics, inflation, supply chain disruptions, and paradigm shifts in the workforce, we remain confident in the continued strength of Korea's economy, which is the world's 10th largest GDP and 9th largest holder of foreign reserves. For those of you who may not know, BNY Mellon is America's oldest bank and a pioneer of the financial industry, with more than 2 centuries of trust and innovation as our legacy. We established a presence in Korea in 1988, and over the years, we've built a strong client base and solid local reputation. We also established an Asia-Pacific Advisory Council, including a representative from Korea, to identify growth opportunities and deliver new, innovative solutions that benefit our clients and the market more broadly. Given our scale and the fact that we touch 20% of all investable assets in the world, we also have the privilege to act as a central orchestrator, connecting most of the world's major financial institutions, fund managers, and Fortune 500 companies. I speak with clients regularly, but the conversations that I have with public pensions and sovereign wealth clients like NPS are some of the most interesting because of their immense responsibility as stewards of wealth for their country's people and their unique role in helping shape economies, markets, and financial infrastructure. This past year, we compiled some of these insights into a study on the evolution of public asset owners. We spoke to nearly 50 public asset owners globally, and I'll share a few of the key trends that we uncovered. First, we found that almost all asset owners want to diversify their portfolios. They're increasing asset allocation to alternatives and private investments, which puts more focus on long versus short-term gains and helps manage risk exposure, while also enabling these institutions to take a more active role in shaping the future. Second, we found that the majority of public asset owners, 63%, are actively reevaluating and forming plans to adapt and transform their current operating models, seeking efficiency, greater transparency, and improved flexibility. And lastly, we heard that 61% of these institutions are focusing on centralizing investment data. Moving data to the core helps them to make faster and more informed investment decisions. And it also helps them align environmental, social, and governance considerations, which are increasingly important. Through this research, we recognize that norms and expectations for investors and public asset owners are shifting. And our goal is to support clients through transformation and help them prepare for where the industry is heading. Part of that preparation involves aligning talent acquisition strategy and development opportunities with growth expectations. This is an area of focus for many financial industry participants in Korea and beyond. As Jeonju becomes increasingly international and industrious, we are committed to supporting the city's development and that of our own highly skilled team. In 2021, we collaborated with the provincial government to launch the Future Global Leaders Mentoring Program, which offers professional skills, training, and mentorship at Jeonju's 2 top universities for dozens of high-potential students. We were able to expand on this success with the support of NPS in 2022, and we look to further scale this program. We're energized by the opportunities that we see in Korea's market and talent pool that will contribute to further economic prosperity. NPS plays an important role in bringing those opportunities to life, and we feel privileged to work alongside them to unlock potential. It was a pleasure to join all of you today. I hope that the rest of the Genie Forum inspires many great ideas, and I look forward to working with our team on the ground to further your goals. Thank you so much for having me.
Well, Mr. Robin Vince, President and CEO of BNY Mellon, has virtually delivered his congratulatory message to deliver or extend his congratulations and celebrations. Thank you very much, Mr. Vince, once again, for sending us such a warm-hearted and insightful message. Well, next, Mr. Maggie Tall, Chair of Carlyle Global Infrastructure, will deliver a keynote speech titled Investing in the Future, the Energy Transition. So without further ado, let me invite him up to the podium. So ladies and gentlemen, please welcome him with a big round of applause.
Good afternoon, distinguished guests and speakers. My name is Maki Tal, and I am a partner and chair of Carlyle's Global Infrastructure Group. It is my honor to be speaking to you today at Jeonbuk International Finance Conference, addressing the important agenda of the future of global finance and investments from the vibrant and historical city of Jeonju. I would like to start by thanking our partners at the NPS who have welcomed me with such warm hospitality. As my Carlyle colleagues can attest, I have always been a big fan of bibimbap, so I was delighted to find out from my friends at the NPS that the city of Jeonju is famous for this dish. Like the city, the dish is not only historically root, but also highly versatile, with enduring qualities that can stand the test of time. And nothing beats experiencing things like this locally. I am also very excited to visit NPS Jeonju headquarters and build on the long-standing and deep relationship we share, for which all of us at Carlyle are grateful. I would also like to thank the organizer and the audience for this opportunity for me to share my thoughts on some of the most pertinent and exciting topics within the global financial and investment community. In keeping with the theme of this conference, I would like to focus on the topic of investing in the energy transition. It is not only an area where we believe private investment capital can create meaningful impact, but also an area where we see significant opportunities and potential. Carlyle is a global investment firm with deep industry expertise and $376 billion US of assets under management. We have a global presence in 26 offices across multiple markets, including South Korea, where we have been active for over 20 years. In the past 2 decades, we have enjoyed great trust and support from distinguished Korean institutions who have been serving across the areas of private equity, credit, real estate, fund of fund, and infrastructure spaces. Over this long period of time, our firm has had the pleasure to work with some of Korea's largest and most important investors, including the NPS, the KIC, as well as insurers, banks, endowment funds, foundations, and security companies. Carlyle has also been active in partnering with some of the best-known homegrown businesses, from KB Financial, Kakao Mobility, to Tucson Place, and Hyundai Glovis to support their continued growth. I lead Carlyle's Global Infrastructure Group, which is active across key infrastructure sectors, including renewable, energy, power, utilities, transportation, and digital infrastructure. As a global investment firm, Carlyle has a unique and important role to play in the energy transition. The amount of capital we have under management enables us to leverage the power of private capital and direct it to areas where we believe we can create meaningful impact. Apart from our scale and platform, we also bring to the table our global cross-market experience. We take a global One Carlyle approach where investment professionals from around the world and across the firm collaborate on deal sourcing and share industry knowledge. Our global resources and network mean we are able to identify and execute on investment opportunities as we look to create value for investors and investees. At Carlyle, our overall philosophy about the energy transition is to invest, not divest. We believe to make a difference, we need to go where the carbon is, to use our capital towards transforming traditional energy producers, which are crucial to the global economy, into more climate-friendly businesses. To expand on how we do so, where we see the energy transition opportunities and understand the role of infrastructure investments, I would like now to share with you a 15-minute pre-recorded video conversation between myself, Megan Starr, Carlyle's Global Head of Impact, and Pooja Goyal, Chief Investment Officer of Carlyle Global Infrastructure Group, where we share insights on investing in the energy transition and where we see the opportunities for investors and companies.
Welcome back to What's Next for Impact. I'm Meg Starr, Global Head of Impact at Carlyle, and today I'm joined by Maki Tal, Chair of Carlyle's Global Infrastructure, and Pooja Goyal, Chief Investment Officer of Carlyle Global Infrastructure. And today we're going to be talking through how Carlyle's navigating the risks and the opportunities presented by climate change and the energy transition on our journey to net zero and beyond. Thank you both so much for joining us today.
Hi Meg, it's a pleasure to be here.
Thank you for having us.
So to kick off, could you tell us a little bit about what your role is at Carlyle and what you do from an investment perspective?
Yes, so I chair the Carlyle's Infrastructure Group, and it's a group that focuses on investment across many sectors, from renewable energy, power, energy from upstream to midstream to downstream, traditional infrastructure sectors such as digital infrastructure, transport, utilities. It's a long list of things that keep us busy.
And my role as Chief Investment Officer of our infrastructure business. And just like Maki said, we cover all of these sectors in infrastructure as well as energy. And one of the most important themes across our business right now is climate change as well as the energy transition.
Amazing. So Maki, to start with you, Carlyle recently announced that we were combining our energy and our infrastructure businesses into a global integrated platform. Can you walk us through a little bit about what the rationale was behind that and how that's helping us more effectively prosecute opportunities in the energy transition?
Yes, it's a really important change in the sense that under one roof, Meg, you really have a very broad spectrum of sector and expertise, from the low end of the carbon intensity to the high end, working as one team. And what that allows us to do is really leverage optimally our leadership, our talent, our expertise, and in a very competitive environment, be able to actually better manage pipeline, show agility on opportunities. And as Pooja was mentioning, an energy transition, really have all of the skill set we need on both sides of the spectrum to be able to be well positioned to play that opportunity well.
Yeah, one thing I hear Pooja say sometimes is that it's a transition, not a revolution. And so it sounds like we need all of those pieces of investment expertise to prosecute that.
Absolutely, we do. As you say, it's a transition. It is a process, and from that perspective, the operational skill set and capacity to really accompany our portfolio companies through that transition is extremely important. And that set of expertise and leaders like Pooja allow us to well accompany our investments and portfolio companies through that transition.
So, Pooja, I want to move on to how we see this impacting companies. So we've seen that more than 90% of global GDP is now covered by government net zero targets. And we see more and more corporates every day setting climate goals, net zero targets. Carlyle set our own net zero target earlier in 2022. Can you walk us through a little bit about why companies are so focused on their climate positioning, energy transition, and how that is actually playing into some investment opportunities on your side?
So broadly speaking, the energy transition, which is this transition away from carbon-intensive fossil fuels to arguably newer and more renewable sources of energy, is a transition that's going to play out over several decades. But more importantly, it's going to result in some serious challenges as well as opportunities. So if you are in the C-suite of a management team right now, and you are thinking about planning ahead for your business, not only for the next 5 years, but the next 10, 15, or 20 years, you need to think about your business being resilient to some of these challenges, as well as making sure that you're going to be capitalizing on some of the opportunities that are available to you. So first and foremost, I think management teams approach the energy transition from a risk management perspective. You know, how do commodity price volatility impact their business? Business interruption due to, real threats to your real assets, for example. And then also, what will be your go-forward cost of capital because of how carbon-intensive your business might be. So I do think it is prudent risk management for these companies to be thinking about their energy transition. Now, if you look at the investments that we've been making within our infrastructure platform, we are actually facilitating this move to less carbon-intensive energy sources for a lot of these companies. So take Carlyle, for example, where we've said that we will be net zero by a certain date across the majority of the portfolio companies that we own directly. We have an investment in a platform where we're developing new renewable energy sources. These are utility-scale renewable energy sources that are available right here in the United States, where if you are a company and you consume energy, one of the lowest hanging fruits that's out there for you is to actually procure renewable energy versus just procuring fossil fuel-based energy, and we can help facilitate that. So we think that there is an opportunity for us to play in terms of helping these businesses think about their transition, both from a risk management perspective, as well as just capitalizing on the opportunity set that might be available on a go-forward basis.
That's really interesting. So Mackie, I want to talk for a second about the concept of real emissions reductions versus on paper emission reduction. And I think that's something we've been seeing a lot in the investment industry, is that you can create emissions reductions on paper, potentially from divesting from certain sectors or your portfolio allocation decisions. But in order to actually change the molecules of carbon dioxide in the atmosphere, we have to focus on the trajectory of individual companies. Can you walk us through some of the ways we were thinking about that across our portfolio, areas where it may be more challenging, and what that means from an investment perspective?
I mean, Meg, that's a huge point. It's a very important point. As we know, the climate faces this huge challenge. It's an urgent challenge. And for that transition to a lower carbon economy to be successful, we need to move the needle. And that is your point in your question, which is we need to actually, in a very concrete way, reduce the carbon intensity. And so we do it in many different ways. I would say the first one, Pooja and I were talking about portfolio companies. Carlyle has been a leader and has committed at the beginning of this year to 2050 net zero objective. The other one is really our philosophy around what we call invest, not divest. And we think that for us to be able to, as a private investor, to have that impact, we need to really make those investments on one hand, on the lower end of the carbon intensity. So things like wind, solar, energy storage, EV infrastructure, emerging technologies such as green hydrogen, green ammonia are all on the low end of the carbon intensity. And there is a need to continue to invest massively into that sector. That is a key part of energy transition. On the other part of the spectrum, we've heard a lot about divestment as the solution. And what we are seeing, and our colleague Jason Thomas has published, our global head of research, a paper that I would encourage you to really read, which really demonstrate that divestment effectively hasn't had as much of an impact as one would have liked, and in some cases has resulted in higher energy prices that we have been experiencing even before this terrible war in Europe. What we are thinking is we need to also invest where the carbon intensity is high in traditional energy and power sector, and do it as a responsible owner of these assets with concrete plans to actually bring meaningful abatement of the carbon emission of these facilities with our capital, with our expertise, but also working in partnership with management companies that are committed to that goal. We think that that's going to be a critical ingredient for a successful energy transition. And of course, we also think that it's going to provide meaningful and attractive investment opportunities.
Yeah, that's a really interesting point. And I think, Pooja, one thing we've talked about before is that the situation that's been going on throughout 2022 with the war in Ukraine, we've seen an increased focus on the topic of energy security. And I was wondering if you could talk us through how those kind of twin goals of energy security and energy transition are playing out in some of the investments you're looking at, and how companies are actually using the energy transition to help them navigate some of these technological disruptions they're seeing.
Yeah, I mean, so up until now, or up until the start of the year, the focus very much as it related to the energy transition was on climate change. It was ESG and climate change driven. I would say more recently, the focus has been on energy security, partly because of geopolitical reasons, but also partly the pandemic has taught us that we need to think about securing our supply chain. So as a result, energy security is just becoming more and more of a focus right now. What I always say is that if you look at the investments that we're making, Mackie referred to them, whether it's in renewables, electric vehicles, charging infrastructure, green hydrogen or green ammonia, both from a climate perspective as well as energy security perspective. So I think you achieve both goals by doing this. Now, I will say that from a technology perspective, the one thing that Mackie said is just incredibly important. He said that when you choose to invest, not divest, you need to do it in a responsible manner. And that responsibility is something that we take incredibly seriously at Carlyle. So when you think about investing in an energy-intensive asset, we want to make sure that we are identifying pathways to decarbonization. Though those pathways might not be commercially viable today, but you need to be able to map out those pathways so that when they become commercially viable, our assets can invest in that technology and actually get to a path where we can reduce our carbon footprint. So energy security is important, climate change is important, but also doing it responsibly, where you have the right data, you're mapping out what your ownership of that asset will look like over the longer term is just incredibly important, and we're helping to do that both. We see that in two different ways. Now, we apply an infrastructure orientation to all the investments that we make in our platform, which means that we primarily invest in assets, but increasingly so, we're investing in new companies and business models that are really well positioned for the energy transition. So that includes investing in a company like Fermata that basically has a bi-directional charger that can charge your electric vehicle and can also send energy back into the grid. Now, that is something that's new and emerging. It is a technology that will scale up over time, but we think that's exciting and it's highly relevant to the rest of our portfolio as well.
Yeah, and that's a topic that I think is really important, how carbon and energy really have to be managed together, that they're not separate entities. And one of the things we've created for our portfolio companies at Carlyle is a carbon and energy management playbook, because we had so many of our 300 plus portfolio companies asking us questions about that. And what we found is that companies could make these great, ambitious climate targets, but if they were divorced from how they were managing and procuring energy, you can't get to that goal. And so it's one of the resources we have about how do you create a step-by-step guide to profitably decarbonize and understand what parts of that pathway may not be economical yet, but you have to have on the forward path so you can plan for them. One last question, as we look forward, what is next in terms of the opportunity set for climate change and the energy transition? What are you excited about? What themes are emerging? And where are you focused over the next 12 months? Mackie, I'll start with you.
Well, I will start just one point ahead, which is hugely important. Pooja has referred to data. And as we move and we have increasing number of organizations, corporations, governments that commit to net zero objectives, they need to be equipped to be able to measure, to benchmark that progress. One of the things we've done at Carlyle was co-sponsor with CalPERS an initiative we call ESG Data Convergence Project. And what we've done there is really try to get more quality data, because we all know what gets measured get improved. And it's a starting point to have transparency, to have quality data. And we've been really working to gather GPs and LPs in the industry to have more quality data, more data, so that it becomes statistically more meaningful. And really excited, Meg, that 9 months after the launch of that initiative, already over 150 GPs and LPs representing over $22 trillion of assets. So it's meaningful and it's developing that tool. I would say that's an important area. And clearly, I find that we have exciting times ahead of us, because the private capital, I am intimately convinced, has a role to play in really making that energy transition successful. And I do believe that at Carlyle, we are well equipped to be able to play a meaningful role in the space.
Amazing.
I have to say the energy transition is just an opportunity set that is just incredibly exciting for me as an investor. And the way we intend to maximize our opportunity set is to really look at the entire value chain, which means that we will be investing in assets, we will be investing in companies that create, maintain, and operate these assets, but we'll also invest further upstream in the value chain in companies that provide equipment or services to facilitate the energy transition. So we really are taking a very holistic approach to investing in the energy transition. The second thing is the management teams. Based on the description that Mackie gave you of our platform, we have the skill set, we have the experience, we have the capital, as well as the tools and resources that these management teams need in terms of thought partnership in order to execute their business models as well. So I would say that that's the second thing that we bring to the table that is particularly exciting because, look, these are complex issues that are going to play out over time. So management teams not only need capital, but they also need that thought leadership alongside with them. And then the last thing I would say is that not all pools of capital are created the same. There are some pools that are more suitable to certain assets and certain risk profiles. And at Carlyle, we have the capital to go ahead and maximize this opportunity set. So I would say those are the three things that are really driving our attention and focus on the energy transition.
Sounds like a lot of exciting work coming up ahead. Mackie and Pooja, thank you so much for joining us on this episode of What's Next for Impact. It's incredible to see how Carlyle's been navigating the risks and the opportunities from climate change and the energy transition. And we're very excited to see what's ahead for Carlyle Global Infrastructure. Thank you both.
Thank you.
Yes, he's not done yet, so please welcome him again with a big round of applause. Thank you.
Thank you very much. So I hope you now have a better understanding of how we think about the energy transition. In the video, you heard us explain Carlyle's philosophy of invest, not divest. Today, there remains significant debate around what the industry can do to accelerate that energy transition. And at Carlyle, we take an inclusive, responsible approach to investing in the energy transition. When it comes, for example, to decarbonization, some investors primarily use divesting from high-emission companies as the primary decarbonization approach. We don't think that's enough. While divesting carbon-intensive businesses can reduce an investor's aggregate portfolio companies, this only creates emissions reduction on paper, but it doesn't in the atmosphere. We believe that in every investment, there is the opportunity to make the business or asset better, rather than only focusing on renewable and nothing else. Even if that is a priority for us, we should understand that it is a process of transition, and we need to invest in to help companies to become less emitting. And so this is why our approach is grounded in driving real emission reductions within our portfolio companies, not just reductions on paper. And it is why when we look at opportunities, we look at the whole spectrum of carbon intensity, from the high carbon intensity energy companies to the low carbon intensity projects. So some of you may ask, why are investors so interested in the energy transition? What are the driving factors behind this boom? The most obvious factor is that there is a supply-demand imbalance resulting in energy prices that have risen sharply around the world. This year, we witnessed oil prices surging above US $100 for the first time since 2014. Natural gas prices also are at a very elevated level, causing existing infrastructure and resources around natural gas to be used at their maximum capacity. At the same time, we have seen a decline in renewable energy costs over the last decade, making this sector even more attractive on a relative basis. Policy support is also adding to the momentum behind the energy transition. For instance, the South Korean government has committed to carbon neutrality goals by 2050, with plans to enhance energy security in a sustainable manner. And apart from financial factors, we are all deeply aware that climate change is one of the most pressing issues of our time. So where are the opportunities when it comes to investing in the energy transition and infrastructure? I would start by reiterating that we believe infrastructure as an asset class presents immense opportunities for long-term investors. Around the world, particularly in emerging economies, infrastructure funding gap remains significant, and there is a dire need of capital. From an investor's perspective, we believe infrastructure provides protection and hedge against inflation, making this even more important as we navigate the current inflationary pressures. It is something that we believe is accretive to a well-constructed portfolio. Looking at the macro environment, given the uncertainty and volatility we live in now, we believe that the need for alternative energy will accelerate the energy transition and create investment opportunities in renewable energy. Apart from renewable energy and emerging alternative energy assets, there are plenty of infrastructure investment opportunities in areas such as battery storage solutions, electrification of transport, carbon capture and storage solutions, and ultimately, the decarbonization of entire supply chains across sectors. I have invested through many economic cycles and across geographies. Throughout the course of my career, infrastructure investments have demonstrated resiliency, including through periods of crisis and economic downturns. It's really the essential nature of these assets that I believe underpin their long-term value. So to illustrate in a very concrete way how we approach infrastructure and energy transition investments in real life, let me take you through two investments where we believe we have created an impact. One example is Alpha Structure, a joint venture between Carlyle and Schneider Electric, combining Schneider Electric's smart energy management and track record as a microgrid technology provider with Carlyle's financial backing and comprehensive structuring capabilities. In 2021, Alpha Structure began constructing and integrating microgrid and electric bus charging infrastructure project for Montgomery County in Maryland in the United States. The project will enable 70 buses in Montgomery County transit fleet to transition from diesel to electric and is projected to reduce the lifetime emissions by more than 160,000 tons while building resilience to climate events and power outages. It also brings the county one step closer to meeting their ambitious climate goals. Another example is CEPSA, which is headquartered in Madrid, in Spain, in Madrid, and is one of Europe's largest privately owned energy companies, which operates across oil, gas, refined products, biofuels, solar power, mobility, and chemical products. Carlyle invested in CEPSA in 2019. Working together with the company's management team and a sovereign wealth fund co-shareholder, we defined an ambitious strategic plan to position the business as a major contributor to the global energy transition with sustainable mobility, biofuels, and green hydrogen. CEPSA offers its customers and partners sustainable energy solutions to help in their decarbonization efforts. So as these examples show, in addition to providing flexible capital, we are able to provide provide developers and business owners with deep expertise thanks to our global infrastructure platform. Our team of 40 investment professionals focus on the infrastructure and energy space, possess the sector expertise and operational acumen necessary to execute the complex value creation plans that infrastructure projects often require. So in closing, I would like to say that the energy transition space deserves a far greater share of attention from us, not only as investors, but as responsible actors in this world. Investing in this space is not just about navigating the volatile market environment or as a hedging move, but more importantly, it is to shape our world for the years to come in a positive way. I hope you found these insights thought-provoking, and I would like to conclude by thanking once again the organizer of the event, Jeonbuk International Finance Conference, and the National Pension Service for having me today. It is a great platform to facilitate important conversations about these current issues and shed light on the role of finance and alternative investments in shaping our future. Thank you very much.
Well, Mr. Maggie Toll, Chair of Carlyle Global Infrastructure, has just delivered a very impressive keynote speech covering both online and offline platforms. Thank you very much. Ladies and gentlemen, please give him another round of big applause. Thank you. Well, now let us begin session 1, titled Alternative Investments in Changing Global Economy. And it will be moderated by Professor Sam-Young Chung, Professor of the Graduate School of Information at Yonsei University. And we are also joined by 4 distinguished panelists, all of whom are seasoned experts in global finance and investment, including Mr. Brent Muller, founder and CEO of AIF Global, and Mr. Bernie McNamara, head of client solutions at CBRE Investment Management. And we're also joined by Mr. Eric Vimont, managing partner and head of strategy at Aris SSG. And last but not least, Mr. Nicholas Ng, managing director of Asia at Clayton, Dubilier and Rice. So I guess we are ready to start session 1. So may I invite the moderator and panelists up on our stage. Ladies and gentlemen, please welcome all of them with a big round of applause. So as was introduced, yes, Professor Chung will be moderating this session. So now let me hand over the microphone to our distinguished moderator. Professor Chung, the floor is yours. Please welcome him again with a big round of applause.
Good afternoon, everyone. Thank you. Thank you. Thank you so much for having me here again. I organized one session last year. It was an alternative investment session, a little different title. Today we have a session title of Alternative Investment in Changing Global Economy. Last year, the title was Alternative Investment in Asian Market. But the difference between last year and this year is that last year, many of the speakers joined through the Zoom online, not that active. The dynamics, I miss the dynamics. But today, look at our great speakers. Speakers come from all the way back, New York, Boston, Singapore, Hong Kong. So please applause all our great speakers here today. And also, I would like to appreciate the organizer, Jeollabuk-do, Jeonju, and NPS. And most importantly, the Congressman 김성주 의원님께 다시 한번 깊이 감사드립니다. Let's see. It is my big honor to do the great session again and again. And the topic, let me give you the topic again. Can you see the topic? Do you have the screen here? Here we go. Alternative investment, global economy. What is the keyword here? Can you see? This is one sentence, alternative investment in changing global economy. I believe the keyword is changing. A lot of changes happening these days. not only alternative investment sector, but the traditional side sector and macro sector, political sector. Everywhere there is a big changes. Today we just have another 75 BP increase from the New York Fed, the US Fed. Jerome Powell, 12 hours ago, announced another third time giant step, right? Market reacted. What happened? About 2% dropped in US market, and Korean market is reacting now. What's going to be happen after market close today? I don't know. We have to watch. What about alternative investment space? Day to day, month to month, in 1 year, in 2 years. That's what we would like to discuss today in next 80 minutes. I'm going to use about 10 minutes of introduction by myself as a moderator, and then I'll give these great speakers the time to discuss their opinions about the market. So, let's see. So this is me. I'm actually professor at Jeonju University currently, and I'm also working with Brant Muller, who is sitting here for the Alternative Investment Forum Global, and he will describe more about that when he speaks later on. So I have 4 different dimensional issues to open this session. One is inflation. I just talked about inflation. And alternative investment, global pension market, and obviously we are here in the NPS. Let's talk a little bit about each of those hot issues here. 2020 May, about 30 months ago, right after the pandemic crashes, 2020 March, Stephen Roach, who is the faculty member of Yale School of Management, Yale University, he made an interesting article on Financial Times. At that time, not many people worry about the inflation. At that time, the central banks pulling a lot of cash and liquidity into the market, too much liquidity. Interest rate was 0, right? Not many people worry about inflation, warning about inflation, but he made clear warnings about the inflation. He said we're going to have a sequencing trap of inflation. And that inflation, if we have such inflation in 1 year, 2 years, it would be structural inflation. And he commented several reasons, including anti-globalization, deglobalization, and supply chain disruption, US-China struggling issue, geopolitical issue, energy price peak, and cost of ESG. And he compared our experience, 1970, late 1970s and 80s inflation, hyperinflation, and the actions taken by the Jeonbuk. He said it took a long time to recover that inflation. Not just 1 year, 2 years, a lot of cost. It might be more difficult this time. 1970s inflation, if you analyze the source of the inflation, it might be 1 factor, 2 factor, based on oil shock, energy shock. This inflation, today's inflation is multidimensional. On the top of that, 1 year later of that article, which is year 2021, the 2 great researchers, Mikhail and Elo, both are BIS, the Bank of International Settlement, and they are working at the NBER, National Bureau of Economic Research. They published an article about inflation demography through time. Well, what they said is that inflation pressure rise when the share of dependents increase, and inflation pressure falls when the working cohort, working age population increase, which is somewhat obvious. We know that. It makes sense. So young and old, which is dependent cohort, if the proportion of those dependent cohort increase out of total population, we may have positive inflation pressure. And working cohort like millennials and MZ generation, the portion increase, we may have what? Downside, negative inflation pressure, because we have more labor force. However, the interesting thing, what they did was that they predict we will have rising inflation in coming decades. And it will be very strong. Consistently, we will have a high inflation, structural inflation, inevitable inflation. So what that means is that out of actual inflation, there is an expected portion, unexpected portion, but we're going to have a whole lot of expected portion of the inflation. Pandemic, Ukraine war, and other Chinese supply chain issue might be, we can regard that unexpected portion. However, the demographic issue, demographic structural changes, we cannot avoid. Let me show you a little. The beauty of their research was they have a data of 150 years of 22 different countries' data. And they analyzed different age group, how different age group affect the country's inflation. And it says clear, if you look at this line, right, the young and old, the age group have it's like a camel back, right, camel back. The positive coefficient, beta, impact to the inflation. And the middle group, which is working cohort, has a negative impact. Obviously, when people die after 80 years ago, after 80 years, our coefficient will go to -1. And it is consistent in different time period. Very significant. The more interesting thing is that they analyzed 22 different countries. They compare past 40 years and next 40 years. What would be the inflation pressure? The baseline is year 2010. So before 40 years before 2010, and after 40 years, what would happen for the inflation pressure? I selected the top 5 countries who has the biggest spread before and after. So here, if you look at that, Spain, Korea, Ireland, Greece, and Italy, for example, the last 4 decades, they had a negative inflation pressure, but next 40 years, they will have a huge positive inflation pressure. Korea is the second rank, right after Spain. I think this is very important. This is why we need to talk about the NPS, National Pension System. National Pension System, reform, and asset management. This is very important. Another thing you may watch out is that they also compare developed country, undeveloped countries, the demographic changes. Look at the United States, UK, and Germany, and France. Those 4 countries, and look at the down 4 countries, Brazil, China, India, and Mexico. Who are they? Or those 8 countries, they have consistently same structural changes between year 2020 and year 2040. Right? The working cohort level, the downside, working cohort level decrease and dependent cohort will increase, which will make inflation pressure. However, the magnitude and the speed of that change would be more significant if we look at the down 4 countries, developing countries. You know, the Brazil, China, India, Mexico, they tend to be factory of the world economy, right? Without considering of deglobalization, just looking at these demographic changes, we may not have such a benefit of low labor from those countries anymore. The benefit would be less. That's why a lot of professionals talking about shortages everywhere. Get the Bridgewater says, we're gonna have a shortage of raw material, energy, and capacity, shipping capacity, housing, and labor. I think I think one of our guests will talking about the housing market, U.S. housing market, in our discussion. What is the prospect of the housing market? So, well, everything is related to the demographic structural changes. It's the technique. Let's look at the alternative investment. We have here, I brought the proportion of alternative investment, different asset classes in the world, global alternative investment. This is the data, second quarter of 2022. And if you look at here, about $10 trillion is invested in the alternative investment. And out of 10 trillion, about 45 to 50%, which is about 5 trillion, is invested in the private equity. The largest portion is private equity. Second largest, real estate. About the same of real estate, we're gonna have a private credit, private debt, private credit. And then next is infrastructure, and then natural resources. One interesting point to me is that compared to domestic alternative investment allocation, here they have a lot of private credit portion here. Think about the NPS. Anyone from NPS here? NPS, how many portion of their total AUM invested in the private credit, private debt? I believe it's less than 1%. Here in the global world, it's about the same level of real estate. Real estate. That means we may need to think about private credit. Correct. There might be some reasons, certain reasons why we have underinvested in Asian market, especially Korean market, but private credit. But it's we have to look at the private credit as well. We will discuss also the ESG of alternative investment. You know, the ESG has been being biased between traditional to alternative investment. It is more focused on public financial market, the traditional equity and bonds, because they have more data. The accessibility of the data is easier. Alternative investment was difficult. But the UN want to make a financial and non-financial data together to develop sustainable finance. So we got to look at the alternative investment space of ESG, private equity ESG, real estate ESG, hedge fund ESG. I will ask these panels about the ESG as well. What is their approach to the ESG? Why they do that? Do they feel the value of ESG, or is it too early to get the profit from the ESG? Is it still cost, ESG cost, ESG risk? What is the reward of that, about the ESG? Global pension fund market, the size. This is the data from the Prekin and BCG. They said currently we have about 57 trillion in 22 big pension countries market. Out of $57 trillion, about $52 trillion, which is 92% are managed in 7 countries, which means very concentrated. Korea is not one of those 7 countries. We have just big giant, NPS. NPS, second largest national pensions in the world, very next to the JPIF, Japan. We have NPS, we have government employee pension fund and others. So total public pension market, the Prekin and BCG estimate about $1 trillion. Plus, if you add other asset owners, like here, insurance asset owners, endowment, family offices, I estimate Korean asset owners market is about $2.5 trillion to $3 trillion. What are the investment theme of this year among those pension funds? We have top 5 big issues, top 5 issues here. One is alternative, how to deal with the alternative investment. Emerging market, how to dealing with the emerging market. LDI, liability-driven investment. Inflation, obviously, top issue. Life cycle asset for defined contribution. Defined contribution versus defined benefit. Defined contribution, the growth of defined contribution is about double of defined benefit these days among those pension world. Those are issues we will discuss. An allocation issue. Different country have a different pension have different allocation portion of alternative and equity and bond here. The big 7 countries pension allocation, alternative investment is about 19%. 19%. How much is the NPS alternative investment? They said it's 15%, but less than, actual, the investment is less than 15% now. We are aiming to increase like 18% NPS. I think no one can read this. This is comparison of different pensions, big pensions. I put that here, NPS, CalSTR, CalPUS, CPPI, and Texas TRS, and GPIF, ART here. And the reason why I put that, the different allocation among different asset classes is to look at the alternative investment proportion. Here, NPS, we have about 11% here. The largest proportion of the alternative investment is CPPI. CPPIB has about 60% of alternative investment. CalSTR has about 38%. CalPUS about 29%. Texas TRS, 43%. GPIF, Japan, they don't like alternative investment, I think. They have less than 2%, GPIF. Australia, retirement trust, they have 31% investment. It is vary, but most of the country has a higher proportion to alternative investment than NPS. Let's look at NPS. We know these things. NPS has we have about 35 years old NPS. The beginning year is 1988. It's partial funding now, right? We know that. We have multidimensional risk surrounding NPS, National Pension Service, as we know every day, day by day from the media. One is the coverage risk, coverage adequacy risk, financial illiteracy risk, second. Third, which is very serious, is longevity risk. We have funding risk, and lastly, we have investment risk. This session is focused on investment risk. Let's look at the investment risk. By the way, if you look at this graph, this is projection of NPS AUM, and they're based on their financial sustainability. And we expect NPS AUM will reach $1.8 trillion US, at around the year 2040, less than 20 years, and it will go down to zero by year 2054 in 12 years. You know what? This is why I believe we need to seriously talk about reform and the asset management. Regarding the reform umbrella, they're talking about pay more, get less benefit, pay longer, get short benefit period. However, all the reform structure is a function of how we manage the NPS assets. 1% increase, decrease make a lot of difference of those projection, of reform projection. Until June of this year, this is the NPS performance. Look at the asset classes. We have financial asset, domestic equity, domestic global equity, so on, fixed income, and alternative. Everything is negative. First 6 months, we lost about 60 billion US dollar out of total AUM. The only positive number here is alternative investment, 7.25%. I'm a little skeptical about the number, 7.25%, because many asset classes and strategy investment products of alternative investment are not market. So we may need to wait. We will discuss in our discussion about that. How long do we need to wait to see the real number of alternative investment performance? Okay, I believe that's my introduction. So we have plenty of topics and issues to discuss this session. And the structure of this session, I would like to introduce one speaker by one speaker and then give each speaker 5 minutes at the beginning for their own introduction, their affiliation, their background, their hopes and dreams, why they are here, what are their affiliated asset classes. So each one of you will take 5 minutes. So who's going to start first? Brant Muller. Mr. Brant Muller, founder and CEO of Alternative Investment Forum Global, and he will introduce himself. Thank you.
Is this on? Okay, there we go. My hopes and dreams, that's a high standard. Anyway, my name is Brant Muller, as mentioned. I founded AIF Global 17 years ago. I did so after serving on investment boards overseeing the US's 3 largest pension plans. AIF is an independent investments think tank. Its mission is to help the world's largest institutional investors, and obviously NPS is at the very top of the list, use alternative asset classes to achieve their investment objectives. AIF operates at the intersection of research and practice. As an example of that, our board is chaired by Harvard Business School professor of investment banking, Josh Lerner, along with several chief investment officers from major US and European pension plans and insurance companies. They alone determine our agenda and our content, and they generate that content together with leading finance academics, such as Professor Chung, investment consultants, asset managers, as our colleagues here, and other subject matter experts. We travel across 4 continents, North America, Asia, Europe, and Australia, throughout the year to try to educate and inform. Truly, that's the notion, and I think everyone we visit with appreciates that, because nobody is hearing everything that they want to hear. Investments obviously trade on information, and you can never have enough good information, particularly from your peers. AIF's research arm, the AIF Institute, is a continuous resource that's offered free of charge to investors. It has 4 centers. One is devoted to ESG and sustainable investing. We've heard a bit about that today. Another is devoted to financial innovation, which basically covers digital assets, data analytics, and then new ideas, financial ideas and structures. Insurance investing, which is a space that I think that we almost have to ourselves, but the world over, among life companies, property casualty companies, healthcare organizations, reinsurance, that's just a very fragmented $40 trillion market. And I think we're seeing in the pension risk transfer part of the world that quiet money is kind of stepping up to the table a lot more. Each center is populated with subject matter experts who serve as its faculty. It's been a great honor to work with Professor Chung on today's presentation. We thought we would invite 3 leading alternative asset managers to represent their respective asset classes. All happen to be also AIF member firms. We've chosen Clayton, Dubilier, and Rice for private equity. Private equity for us goes all the way from venture to big buyout, so a lot of territory there. Ares for private credit, and CBRE for real assets, which in turn would consist of real estate and infrastructure. Actually, also, Ares is active in the infrastructure debt space, so I think we will draw upon that expertise as well. And as Professor Chung has said, and I think in my view, there are more macro variables at play today than at any other time in AIF's nearly 20-year history. I think it's pretty fair to say. Some of the alternative asset classes that fared best in the sustained bull market and low rate environment are now challenged. Other asset classes or business models that fell out of favor may well be back in the conversation. The one that leaps to mind is hedge fund strategies. We don't have anybody directly representing hedge funds today, but obviously the value proposition of hedge funds may be more prominent in a world where the public equities markets are far more choppy, and one looks to the use of techniques like leverage shorting and derivatives to help realize returns. With that, I'll turn it over to Professor Chung. This is his session to lead, and I will from time to time chime in with comments.
Bernie, can you do that? Standing here?
Sure.
Yes. Because we have slides to show.
I can't be in front of a crowd without slides here. Thank you, Professor Chung and Brandt, and thank you to the provincial government, to Jeonju City, and to NPS and the conference organizers. Really an honor to be here together with my colleague Mark Jun, who's based in Seoul and the head of our APAC Client Solutions team. We're deeply honored to be here together with you in person. We represent CBRE Investment Management, the Real Assets Investment Management division of CBRE Group. We are focused as a platform on delivering sustainable real asset solutions for our clients and communities. We do that by investing across real estate and infrastructure, equity and credit, private and public markets in a range of implementation formats, from funds to direct separate account investing to JVs and co-investments. The foundation of our business is pensions. Over 70% of our assets under management is for pension plans on a global basis, in particular public pension plans. We also have a long-standing commitment to Korea. We have been in the country at the CBRE group level for over 25 years. We have more than 300 employees in the country and have been investing from our investment management division for over 15 years. Professor Chung asked about our hopes, dreams, and aspirations, and I think those are wrapped up a bit in the current macro and market environment. And so I have just a few slides going through the broader macro and market picture with respect to real assets, as well as current risks and opportunities. So I'll try to be brief here. Starting first with the macro picture. So here we're showing GDP levels and projections on the left-hand side from just before COVID and going forward, and on the right-hand side from earlier this year and beyond. And just quickly around the regions, in APAC, the real news is around China, which by many accounts is in what's known as a balance sheet recession. That's been caused by one, intentional government intervention to deflate over-leveraged residential developers, and two, of course, by the zero COVID policy, including Chengdu, for example, going back into total lockdown last week, and we don't expect those lockdowns to end anytime before the October Party Congress at the earliest. In Europe, as we've heard, obviously challenged by the Ukraine-Russia war, soaring prices pretty much across the board, concerns about energy supply. And in the US, the picture is a bit murkier. Really strong labor market, somewhat sheltered from the commodity mayhem by being energy and food independent. But the real question is whether the Fed judges things correctly and deflates just enough, including yesterday's 75 basis point hike, or tips over too much into a recession. So from a global macro perspective, we really like APAC, some concerns about China. We're constructive on the US, and we're cautious about Europe. But I think it's important to keep the situation, even in Europe, in some historical context. I would characterize this as the don't panic slide with respect to Europe, at least not just yet. And the headline here is that the forecast recession for Europe this winter is not expected to be either the prolonged downturn of the GFC, which you can see in the light green line, or the sharp crash of COVID in the black line, but expected to be much more shallow and shorter. From a capital markets and credit markets perspective, 3 key points here. No longer regime agnostic, meaning we've seen a separation or stratification of interest rate and broader macro environments globally versus the relatively synchronized regimes we've seen across regions over the last several years. Obviously, the denominator effect, the resulting search for yield and total returns that investors are pursuing. I'm sure we'll get into that topic. Lastly there, tighter financing costs impacting both buyers and sellers in real assets. From a risk positioning perspective, I would characterize our stance as cycle aware, both with respect to the current cycle as well as some historical perspective. So what that means in practice is that, for example, on the real estate side, we are very focused on mitigating leasing risk, bringing down LTVs, particularly in higher return closed-end strategies. But we are prepared to take sensible risk, including development, particularly in logistics, as well as other what we call next-gen growth sectors, which we'll touch on in just a bit. And the last point here is a bit of historical perspective, which is that we are staying in the market. One, because of the opportunities that are likely to present themselves given the near-term volatility that we're experiencing. But two, because of the challenge of the time and effort associated with restarting the machine if you completely unplug from the market and let atrophy relationships with buyers, sellers, lenders, brokers. That was a lesson that many learned the hard way post the financial crisis when they weren't ready or resourced to take advantage of opportunities as they presented themselves. Final slide here, I promise, just in terms of preferred strategies. Again, a focus on those next-gen areas, particularly structural growth sectors that are backed by generational demand, in particular logistics and residential, pretty much across regions. Capitalizing on mispricing opportunities, particularly in the listed real asset markets, especially listed REITs, where the view is that those have been oversold versus the strength of underlying fundamentals. Defensive plays, I know that we'll get into credit, in particular floating rate credit, but also inflation-sensitive infrastructure. And then the last item, urban renewal and asset transformation. That is code for the future of office perhaps being the future of mixed use, meaning bringing together office, retail, and residential in vibrant placemaking urban settings. So with that as a bit of context, Professor Chung, I will hand it back to you.
Thank you. Thank you. All right. Next, Eric Wieman. Eric is from the Ares SSG. Eric, yeah.
Thank you, Sam. So First, echoing what just Bernie said, thank you very much for having me here. It's an honor. Just maybe a quick introduction by myself, and then I just want to present Ares, an overview for those of you that are not aware of the firm. So I actually been in the firm.
By the way, Eric, if you want, you can stand here too.
I just have one slide, so it's okay. I probably could stay here. So I've been in the firm for 15 years. I actually joined Ares in London, initially very much hired to develop their private credit franchise in Europe. We grew that franchise to be the leading platform in that continent. And I'm sure this will be a big topic for today, how we did that and how do we face the 2010, 11, and 12 scenarios, which are likely to be replicated over the next few years. And second, I basically was asked to move to Asia in 2018 to really launch Ares in the region. We did that by acquiring a platform called SSG, which was probably the most, I would say, advanced credit investor in Asia. And I'm now participating in leading that effort in Asia to continue to develop the private credit product in the region. So maybe moving a little bit into the Ares presentation, I just want maybe to spend a bit of time on the first slide, which is the group, just the one before that one. So Ares has been in existence since 1997. We're actually celebrating our 25th year this year. And we're listed on the New York Stock Exchange. We manage around $330 billion of assets. And I would say we do this on behalf of around 2,000 different investors. Obviously, some of you here in the room. We obviously developed along different routes and become a very diversified alternative asset manager. But having said that, one thing you'll notice on this slide is that the largest exposure that we have is in private credit, and credit generally speaking, with more than 60% of our assets under management in that particular strategy today. I know we'll talk a little about defining what it means credit in the alternative world, which we'll do later on, but that is very much where we come from and where we continue to be a leading force. Since then, we've diversified into other verticals. We're now in private equity, real assets, real estate on the private equity side and the debt side, as well as infrastructure, on the private equity side as well, the debt side. And what we called actually secondaries. We made an acquisition last year, which has been meaningful to us to be part of the secondaries strategies, which is ultimately lending to you, i.e. LPs, to crystallize value out of the portfolio and investment pool, or helping GPs to crystallize solution to create liquidity. And then we have the strategic initiatives, which are for us growth areas that we believe has a big impact for us in the future and for LPs, but needs nurturing. Out of this, we have Asia, which we just started, as I mentioned, in 2020. And then we have our insurance portal, which we are developing very actively right now globally. Now, one thing I would say, if I wanted to take one step back and say, how do I distinguish Ares? And I'll probably spot maybe 4 key characteristics. One is because more than 60% of what we do is in the credit space, we are as a firm very downside protection minded. In everything we do, and we can touch a lot of these verticals, a lot of our investment philosophy is around how do I get my money back? And how do I look into the value so that I feel conservative enough when I look at my return scenario? And everything that we touch is very much driven by this DNA and this mentality. The second aspect is we are big believers that the best way to really understand your risk is to be close to your asset. That means we are big investors in origination and sourcing. And if you think about a lot of things we do, we typically have very often the largest teams of origination, sourcing in many of our verticals, in many of the jurisdictions that we actually serve. We want to not only find the risk, we want to structure it, we want to be able to monitor it and find the exit. And that's the best way for us to make sure we are full control on the return that we're promising to LPs. The third aspect is the collaboration. One of the mantra of the group is find the right company, the right asset, and then find a way to create the solution that ultimately provide the right risk-adjusted return. To do this, we tend to be flexible in terms of the solution that we want to bring. It can be a senior loan, it can be a subordinated situation, it can be an equity solution. And to do that very well, we like collaboration. So we foment within the firm an extensive collaboration platform where people talk to each other around how do we get to this particular borrower? What did we learn from relative value comparisons between different sectors, different behaviors, different assets? Where should we spend some time given some of the characteristics that we've seen in certain markets? And that allows us to be much more responsive and find opportunities very quickly. The last and the fourth one I would want to touch on, and I know we talk a lot about making returns, but we spend a lot of time as a firm to think about how do we impact the rest of the society. It's not only about investment, it's about how do we return some of that back to the constituents we serve. ESG is part of that project, and I know we're going to talk about this. But we have as well a very, very strong diversity and inclusion program internally, which we've been developing very actively. And third is our charitable contribution, whether it's actually people contributing to the society or what we actually go back or give back in terms of financial contribution, how we help and measure those impacts. Very important the way we think about Ares and how our constituents actually think about their role in society. That's for me would be the summary. Obviously, we will spend a lot of time on what we do, but in terms of how I would introduce Ares.
Thank you. Thank you. Nick, can you introduce?
Yeah. My name is Nicholas Ng. I'm from Clayton, Dublin, and Rice. We're a U.S. buyout fund headquartered in New York. Before I talk a bit about my firm and also reacting to some of the observations Sam highlighted earlier, I was born and raised in Hong Kong, and for the past 10 years, I spent a big part of my career as an allocator. I was a limited partners in 2 respective organizations. More recently with China Ping An Insurance, and I helped place the onshore insurance premium in overseas market by investing in funds and also co-investing alongside GPs. And before that, I spent 7 years in the Hong Kong Monetary Authority. I was part of the founding team of the Alternative Investment Program back in 2010, and we grew the program from the scratch. And today they have 100 billion of asset under management in alternative, and being one of the biggest private market investors in Asia. And in many different transactions, we work alongside our friends in NPS. So we've been sort of, basically, learning a lot in the past 10 years, and also basically has been sort of comparing notes and what we observe in the macro market. So I joined CD&R recently as Managing Director and Head of Asia. There are 3 different dimensions of my responsibility. One is I collaborate with our investment partners here in Asia, including the pensions in Korea, including a lot of sovereign wealth funds in the region. And currently we have around 15 billion AUM coming out from institutional investors across the whole APAC region. And secondly, we have 2 JV partnerships, one in India and one in China. And third, then I aspire to create value creations for our portfolio companies in the US and Europe. And sort of moving into who is CD&R, we are founded in 1978, one of the sort of earlier PE investors globally. And we consider ourselves as a pioneer in deploying a operationally focused strategy in PE investing. So as opposed to relying a lot on leverage and multiple expansion, we focus our mind in driving operational improvement for our portfolio companies. In a typical case, during our investment period, our portfolio company will usually be able to double the EBITDA, and that is how we generate return for our investing partners. We focus on a few industry verticals: industrial, consumer retail, financial services, technology, and healthcare. And the way we prosecute transaction is we rely on our sort of deep bench of operational talents. well, for the four founders of CD&R, three of them were former CEO and business builders. So they understand how to drive operational improvement, and that root of a history has been very important for us in our DNA and also how we do investment. So currently we are in our sort of operating partners and advisors bench. We have the former CEO of P&G, David Taylor. We have the number 2 person in Unilever, Vindy Banger. We have the former CEO of Johnson & Johnson in the past, Jack Welch, the former CEO of GE, served as an advisor of CD&R until he passed away in 2020. So this is, we consider that as basically one of the very important operating elements of a firm. So that's a quick introduction of myself and also the firm. And reacting to what Sam mentioned about the whole macro context. Well, apparently has not been easy, and we are basically entering into a new era of macro environment. But one thing I actually want to remind all of us is we have never living in an easy world. And if we think about what happened in the past 15 years, we have the GFC, we have Brexit, we have the European debt crisis, and Asia, while the growth trend has been healthy, and at the same time, many different jurisdictions are facing a lot of sort of structural issues. And how we see the world is we focus on the first principle of how to build a good business. So we tend to be more micro investor, not saying that we ignore the whole macro context, but we really basically putting our focus on how to basically build the key elements of having a fundamentally strong business. And this is basically the way we have been operating in the past 44 years, and it will be the way we try to generate alpha for investors in a sort of next era of a macro environment. And talking about a few things like inflation, I think on one hand that sort of create a lot of challenge, and also basically it's a sort of like a new element that a lot of CEOs we need to consider about. But at the flip side, that also drives a lot of C-suite executives to be more focused on productivity and efficiency. And also along the way, there will be a lot of complication and complexity to be solved. And we see ourselves as a solution capital. So basically we are here to partner with the seller or with our counterparties to solve corporate complexity. And as we are encountering a lot of sort of macro challenge, we think there will be more corporates that will need help in sort of how to mitigate the risks we see at the moment. So while we are mindful and cautious about a lot of changes happening around the world, at the same time we are encouraged and also optimistic in terms of how the new environment is going to create new investment opportunities to us. And that happened in basically the few years after the GFC, and that was basically back to our Fund 8, and that was one of our sort of strongest fund in our history. So we do see that as a micro investors and as an operationally focused PE investor, there will be opportunities where we can crack in the next era. So that's, I would say, a sort of quick context, and I'm happy to drill into any sort of particular issues.
Thank you. Right. Okay. Can I get back my question? Now, we have about 30 minutes to discuss the real questions. I have actually 3 questions here. Can you pull up the questions here? Okay. 3 questions. Question number 1 is, what do you think of the global alternative investment market trend before, around pandemic period? Do we have any changes? For example, how would you characterize investor sentiment around this time period? Is there any changes? What is the impact of a rising rate on your asset class? Real estate, private equity, private credit, and what about overall alternative investment investors, pension fund, to the Brand Muller? What is the impact of inflation on your respective asset classes and the strategy as well, respective strategy? Are you tilting, tilting, rebalancing, changing something about your portfolio based on these changes, global macroeconomy? That's the number 1 question. So, yeah, who's going to start? Bunny, or can you start?
Sure.
Real estate and infrastructure, are you?
Now, bearing in mind, each of these folks is representing not just their own firm, but their asset class, right? So they're
Asset
having a
class.
broader conversation
Yeah.
about how their asset class is
class.
affected.
Sure. So I'll start by observing that I think one of the key trends that we've seen through COVID and hopefully coming out the other side of it is the acceleration of some structural changes that were already in place heading into the pandemic. And that's been true across both real estate and infrastructure. And a related trend I would note is increasingly more and more investors candidly following the lead of NPS and taking what I would characterize as an all-of-the-above approach to real assets investing, meaning investing across real estate and infrastructure and other categories, equity and credit, private and public markets, embracing different formats of implementation. And I think the rationale for that is twofold. One is due to the lower correlation characteristics of different real asset categories versus one another. There's portfolio diversification benefits to doing so, but also the opportunities that have evolved or accelerated through COVID, as well as the risks, I think can be addressed more holistically through a flexible all-of-the-above approach. But maybe digging a bit deeper on each of the respective categories, real estate and infrastructure, both portfolio, construction trends, as well as some trends at the sector level. Within real estate, I would note the acceleration and evolution of investor portfolios from what I would characterize as 1.0 allocations to 2.0 and 3.0 and beyond, meaning 1.0 allocations had been characterized by overweight to office in particular, large format retail. And maybe 7 to 10 years ago, many investors started to tilt more towards what we would characterize as 2.0 allocations, which principally meant overweighting logistics and residential. And now through COVID, we've seen an acceleration of investor portfolios to 3.0 allocations, meaning an embrace of structural growth sectors, not just residential and logistics, but for example, in the US, self-storage, cold storage, data centers, life science, specialty residential, student housing, single family for rent. And so that evolution is happening. Within infrastructure, a variety of different themes accentuated through COVID. Energy has been touched on here, renewables versus fossil fuel, energy security and transition. Within infrastructure, transportation infrastructure, I would note that a lesson learned through the pandemic has been understanding better the risk associated with demand-based contracts that underpin infrastructure investments, where payments are tied simply to volume usage versus the government-backed availability-based contract structure, which provides payment regardless of volume. That came into very sharp focus when demand essentially switched off overnight for most forms of both personal and commercial transportation. Social infrastructure has come into sharper focus during the pandemic, including the need for hospitals, regulated, affordable housing, as well as better funded schools that have the technology capabilities to support, for example, hybrid learning. And maybe the last comment I would make is, speaking of the term social, within ESG, clearly an acceleration of the focus on ESG, moving from nice to have for many investors and candidly many managers to table stakes as a need to address the climate crisis. The genie is out of the bottle with respect to both public and private capital focused on the climate crisis.
Bernie, just a question on my end. How do you get out from under the cyclicality and debt dependency of real estate? I mean, it just inherently has that component to it. And then the second question I'd ask you, since you're covering infrastructure and real estate both, is I think we learned during COVID that portfolio construction and infrastructure is quite important, right? I mean, people might have looked at things like airports as relatively stable.
Sure.
For a period of time there was close to a wipeout there. So I'm sorry, both of those, you can balance both questions.
No, sure. So maybe starting with the second one first. I think COVID helped to further define and clarify the lines of definition around what is truly core infrastructure. I think the market has a good understanding built over decades of what core real estate looks like in terms of well-leased, well-located properties that generally have stable long-term cash flows. And the assumption was that by many, all infrastructure assets as essential to the functioning of society and commerce, all infrastructure assets, because they're essential, must by definition be truly core. But Brant, I think you're highlighting that that was exposed during COVID, particularly around transport infrastructure, as I mentioned, with the demand for whether planes, trains, bus transportation switched off effectively overnight and led to a more nuanced understanding of what core infrastructure transport investing looks like, with again an emphasis on availability-based contracts, which has a government guarantee as long as the asset is available, versus demand-based contracts. And then to the question of the cyclicality of real estate in general, no question that we are exposed within real estate to both economic as well as cyclical growth. But our focus in terms of securing long-term investment performance is increasingly around those sectors that have structural secular growth tailwinds to them, including residential and logistics, where there is just a critical need for new modern assets, but also the emerging growth sectors that I mentioned, self-storage, cold storage, data centers. And so the key is to be cycle aware and secularly responsive in terms of your real estate investing. Sorry, long answer.
Thank you, Bernie. I just realized we have only 20 minutes left. So I try to merge question number one. Question number two is here. It's a related question. Number two is, what is your top 3 risk and opportunity in your asset class? So you can talk about any changes during after pandemic and risk opportunity you're thinking about.
Okay, so I've got 2 questions to cover. Okay, fine. So maybe starting from a high-level point of view, and I'm going to, as mentioned earlier, I'm going to focus on private credit. From the 2000, so we started private credit, our firm in 2000. From where we stand today, we've registered double-digit percentage CAGR growth in the asset class, literally every year. And our contention is that over the next 5 years, we're likely to see the same. We think that, therefore, that particular asset class is likely to double. That's our contention at Ares. Why is that? One particular driver behind the private credit space is we are replacing the banks. The banks used to do all this credit, but gradually, because of cycles, because of regulatory pressure, have got out of those areas. And that's really what creates a gap for people like ourselves to fill and provide those opportunities to our LPs. That's an important driver which gets accelerated every time there's a crisis. That's why we believe that what we're having ahead of us is potentially for another trigger of acceleration. The second aspect is, over the last years, it's been proven, at least on our side, that it's an asset across cycle that still performs very well, remains very stable, with high income generation, and a fairly good and correlated risk to most other indices. And that, I think, is another point we'll touch on. The other aspect, which actually as well has been driving this, is the liquid part. So these are the security, the public securities. We've seen an increasing amount of volatility in those public securities over time. And that obviously is creating issues in terms of planning ahead for an investor. Reasons for this are multiple, but if you think about first the constituents of those public indexes, we've seen actually the importance of large issuers, whether it's equity or bonds, increasing over time, which is skewing, in effect, those public securities valuation over a period of time. The second aspect is the advent of passive investments. With so many passive instruments coming into market, you have to wonder whether fundamental is still in line with behavior, right? Some of these indices are moving quickly because of flows rather than actually fundamentals. And all this have made life complicated for many investors where private debt has been able to show more stability in a closed-end format. So now, what do we define as private debt? Because people are coming back and say, okay, is it lending to companies? Is it more broader than this? What are you talking about? So, in a nutshell, is providing a credit solution to either a company or the owner of an asset where you have security over the value of that company or the value of that asset. And you're getting paid on the basis of the cash flow, which is being generated by that company or that asset. So that could be very much lending to companies, but it could be lending into an infrastructure project, into a real estate project, even to a diversified set of assets. For example, what we call the granular, if you want, assets, whether it's a pool of loans, a pool of mortgages, a pool of royalties, of fees, all that predictable cash flows is leverageable, and we provide credit against this. Now, thinking a little bit about the risk now, inflation that we see today, or interest rate, or other risks that we could anticipate, and where we're seeing ourselves positioned. The success of private debt is really based on certain fundamentals that are very important for you all to understand, because that's how we believe we're able to navigate those risks. As I mentioned earlier, you need to be close to your assets. So we source our assets ourselves. And that basically means we actually do a ton of due diligence. We understand those sectors intimately. We understand those borrowers over a long period of time. We are today backing around 3,000 companies plus in the firm. We've seen trends over years of different sectors, different players, and we're able to take views on who actually are likely to be the winners in the future. The second aspect is that over time we've been very disciplined, and we've gone through those cycles and understood that you have to back the best assets and the best borrowers, and we qualify them by people that, let's say, companies that have high barriers to entry, leaders of market, high switching costs for their customers, low burden from their capex requirements, which basically means that they have some power to pass the price hike to their customers. They have some power to actually take pressure on the balance sheet and have enough cash flow to basically help them navigate. They have some power to buy the number 2 and 3 and 4 in that market, because those entities don't have the means of competing efficiently. Being able to pursue with discipline those assets or those companies differentiates yourself from the competition. And that's how you build a private debt or private credit portfolio, which is durable over a long period of time. The other aspect is you need to be close to those assets when you asset manage those risks. We are all third lien or secured as a priority over those assets. It basically means that behind us, and no obviously disrespect for my next player, but we have a private equity owner that owns the first piece of loss. In those circumstances, there's a lot of ability for us to create a covenant trigger or protective trigger within our capital structure, which allows us to take ownership of an asset before it loses its value. And that's very important. You need to have the ability to work through those triggers, structure them appropriately, or have the ability to own those assets and monetize them before the value breaks into your position. And that's common around the entire private credit space. And that's the only way you can make it work over a long period of time. That's why when we look now in terms of the interest rate and the inflation, interest rate first, most of what we do is floating rate. So there's actually a lot of value embedded in private credit because as the interest rate goes up, our floating rate goes up, and there's more value flowing back to the LPs. Second, as those deals are being now crystallized, they are crystallized with a different value, which means that our debt and our private credit is actually more conservative, and therefore we are able to reprice and reset that risk in a new era of valuation, which is very important. The other aspect as well is the inflation obviously plays differently across many sectors. Some are labor costs, some are goods, commodities. Having a very diversified portfolio where you typically have around 1.5%, 2% position max allows you to really offset a lot of those trends that hit potentially that portfolio. And you're able to reprice it when the covenant is hit. You're able to have conversations with equity owners that actually want to work with you to preserve value for longer because they know that we have the first call on those assets. So all these dimensions mean that we feel we are very well positioned for the current cycle. We think that the bank's retrenchment will help us as well to accelerate that growth. Having said that, you're asking for the three risks. One for us, I think, is the black swan event. I mean, we all recognize here that whether it's geopolitics, whether it's the war, whether it's the pressure on democracies in the Western world, whether it's the climate, there are events that are just impossible to price. We can't just stop working. We just have to make sure we remain selective, we remain disciplined, and we diversify. And I think as long as we are firstly in everything which is private credit, we should be able to go through the other side. The second big risk for me is obviously the interest rate. I think it was talked about. Are the central banks likely to calibrate it in such a way that the recession is not going to go out of control for a long period of time with a lot of pain? That is difficult to answer, but it's something to watch. The third one for me is the role of the dollar. Obviously, sitting here in Asia today and understanding how the dollar is having an impact on our investment in terms of the hedging side of things, or even in terms of the flows that we're seeing affecting the companies that we try to support, is something to watch and something to really try to understand over a longer period of time. And these are the risks that we have in mind. In terms of the opportunity set, I already touched on this, I'll finish in this one. I think there is an opportunity today to position yourself for the next 3-4 years, which are going to be difficult. And the one way to do this is to go into those assets today that are mispriced by the market. Because either it's a public asset where people are taking a very, very brush view and are not close to the fundamentals of the company, and you're able to realize that ultimately this company is worth much more than what the people are trading that company at. And that's something which, if you have a very deep understanding of the sector and the players, you're able to take a call on. And that's what we do internally into our special operation or special opportunities. The other one is to really try to look at some of those return and recovery type of situations where a lot of big corporates are in need of liquidity and they will sell assets or they will structure their grouping of assets, and you can help them realize that value. And you can help them realize that value at a lower valuation cut by giving them either a senior piece or an equity piece or a hybrid piece on an asset pool, on a single asset, or on a company.
Thank you, Eric. We have time.
Thank you.
Thank you. Thank you. So I'll give you the rest of the time, Nick. It's all yours. 9 minutes.
Sure.
So what is your top three risk and reward? And also, please answer the final question of, are we expecting private equity market follow to the public market? Is it
Sure, yeah.
stale pricing?
Well, I might address
Use the remaining time.
Sure, yeah. I might address the last question first. Whether private market investment is simply public market with a more stable pricing. And well, I think private market investment has has pretty proven track record of the ability in delivering outstanding returns across many different classes within private, be it private credits or real estate or PE. And first of all, I think there are a few things I would like to share. One is the secondary market for private assets have become very, very big. And the pricing mechanism for the private market has been pretty healthy. So I wouldn't consider the so-called stable pricing being a sort of like a superficial stability of the market. So basically there's the good buyers and sellers within private that can drive to a pricing equilibrium. So any pricing that really pushed the GPs to be more sort of analytically robust and also putting more institutionalized process to monitor and also drive the pricing decisions on a lot of assets. So that's basically my first argument and also first observation with the progression of the whole private market development. And second is we have a lot of data points to prove that private ownership is a more effective point of corporate management and ownership than public. And by the same token, I think like private lenders are also, to many extents, are more effective than some bank lending. And the reason being, well, I'm sort of switching back to the equity side. And if a company is under private ownership, the management team have a better flexibility to have a more long-term strategic mindset as opposed to caring about the earnings for the next quarter. And that allows them to basically be more intellectually honest to do things that is for the long-term goods for the company. So that's sort of one argument to and also support why private has been sort of outperforming public for a long period of time. And secondly, private ownership allows investors and also shareholders to drive better management and shareholder interest alignment. So like be it the ESOP program, also basically hiring better quality management team. I think that's the second thing. And third thing is private ownership also allows shareholders to have more sort of weapon at disposal in designing an optimal capital structure. And along that dimension, of course, we work together with a lot of private investors, especially in the current environment. Like a lot of sort of leverage is drying up, and then basically we can be more creative in designing the optimal capital structure to support the growth and also serving the long-term goods for the company. So, I think there's a lot of sort of intellectual and academic arguments to prove that private is still a good asset class, and overall we still a secular trends of institutional investors like pension, sovereign wealth funds placing more capital in private.
Ron, do you have any comments on that with the next question? Well,
I guess my overall comment is, I think David Swenson probably would have said, or the endowment model would have been, you should only be as liquid as you need to be, right? I mean, the great advantage of a big pension fund is the ability to take the illiquidity premium, right? And that is, it always amazes me, we had a bit of a conversation about this, that when you invest in public companies, there's an illusion that you know all this information about the company. In many respects, I'm guessing you'd all agree that you know a lot less about the company when you buy a share of stock on a public exchange than when you do your diligence on it. So that, for me, is just, in a way, the takeaway, Nick, from what you were saying. Because I think that illiquidity premium and the complexity premium, things that you can do, just seem to me less risky.
Yes, I mean, that's a great point. And so we do see sort of sovereign wealth funds who basically looking into the prospect of the country or a city for the next 50 years. And they love private. So as to your point, Brent, and basically they can afford to sacrifice like liquidity for a high return in long term. And same as the pension is in Korea. I think, Sam, you mentioned a good point. In 30 years' time, the pension can dry up, but you still have a 30-year horizon to plan your financial situation. Yeah. And that sort of gives you enough room to sort of place your capital in private, which might have a lockup, but at the same time, it does sort of gives you premium return in long term.
Thank you. Thank you. Bernie, do you have any additional comments on that stale pricing issue?
Well, I think
market.
Sure. Yeah, and this is a question.
Real estate.
Yes, this is a question that comes up frequently in real estate, and actually is a question that is in very sharp focus right now. because there is a wide separation between public market pricing and private market pricing within real estate. And I think the answer of whether the private markets are just the public markets with stale pricing varies by sector, candidly. On average, you're seeing double-digit discounts in terms of public market pricing versus the underlying implied net asset value of the real estate on average across sectors and regions. That's a relatively historically wide discount, has not happened very frequently. And I think if you look through to the underlying sectors, a discount within, for example, logistics of 15 to 20%, we would not expect that kind of correction in the private markets due to the strength of the underlying fundamentals. So a bit of public market noise and perhaps overreaction. But if you look at office, the discount was as high as 49%. That is a big number. However, it might actually be accurate, depending on the type of office. There is a wide separation between dated legacy office and new, modern, smart, amenitized office. And we believe in the latter, smart, amenitized, modern office, and have a lot of concern about dated legacy office. And by the way, dated is measured perhaps on a spectrum of being more than 5 years old. The office market has changed that dramatically. And the old saying, and I borrowed this from an old colleague, that things are going to get worse before they get better. For certain types of office, I think things are going to get worse before they get worse. And that's a reality that many investors have to deal with, and is actually a central focus of some difficult conversations we're having with clients who have high office exposure. So I think it's a nuanced answer depending on the sector in terms of the relation between public market pricing and private market pricing.
Not only the sector, it really depends on the A's and Class A or Class B, CBD, or all depends on the case by case.
For sure.
That's what you said. But you said 45% discount on office. Is that the on average office? U.S. average?
Yeah, 49% as the U.S. average.
I see. What about the residential, do you believe? The residential?
Yeah, very, very constructive on the residential market globally, but in the U.S. Especially, just given the cost of living crisis that is occurring in many markets across the globe. And in the U.S., depending on estimates, we've got anywhere from a 3 to 5 million unit shortage in terms of new housing stock that's needed in the wake of changing demographics through time. And so residential we view as one of those structural secular growth sectors right alongside logistics, and is a major area of focus for us, not just in traditional multifamily, but increasingly in specialty residential subsectors, including single family for rent, as well as student housing, where there's a critical shortage and need for modern amenitized product.
Thank you, thank you. Our clock stopped. Brant, could you close our session? Thank you. Mike, please use Mike.
It's a wonderful group. Obviously, each of you covered a lot of territory. I think the big takeaway is this is a bunch of believers in the fact that private investments, private capital has a lot of great advantages to it. And I look forward to having this conversation, hopefully many times in the future with this audience. It's been a great honor and privilege for us.
Thank you so much. We just stand here. Thank you.
So that concludes session 1 of Jeonbuk International Finance Conference 2022. We would like to express our heartfelt appreciation to our excellent moderator, Professor Samyoung Chung from the Graduate School of Information at Yonsei University, who made it possible for us to enjoy passionate debates, as well as all of our eloquent panelists and speakers as well. Thank you so much. Ladies and gentlemen, before we let them go, please give them another round of big applause. Thank you very much. Now we are going to take a 20-minute break, and session 2 will commence at 3:50 p.m. Korean Standard Time, so please stay tuned, and we will see you again in about 20 minutes. Now please enjoy your break. Thank you. Your Excellencies, distinguished guests, ladies and gentlemen, welcome back. Now let us commence session 2 of Jeonbuk International Finance Conference 2022. Well, once again, please note that Jeonbuk International Finance Conference 2022 is being broadcast live as we speak via the official website of JIFIC 2022 and the Genie Forum. So please join us online and stay tuned. So without further ado, let us begin session 2, titled Energy and the Role of Regional Finance. Well, session 2 will be moderated by Professor Jeonju Nielsen, professor at Seongkyungwan University's Graduate School of Business. And we are joined by 3 distinguished panelists, including Dr. Ben Meng, Executive Vice President and Chairman of Asia Pacific at Franklin Templeton, and Dr. Hee-Nam Choi, Visiting Fellow at Korea Capital Market Institute and former Chairman and CEO of Korea Investment Corporation, and Dr. Yoon-Seok Lee, Senior Research Fellow at Korea Institute of Finance. So without further ado, let me hand over the microphone to our exceptional moderator, Professor Jeonju Nielsen. The floor is yours. Ladies and gentlemen, please welcome her and our panelists with a big round of applause.
Good afternoon. Welcome to our session. My name is Jeonju Nielsen. I'm professor at Seongkyungwan University, SKK GSB. Before I became professor, I was a portfolio manager and trader at the Wall Street major firms, more than 15 years. Today, I'll be serving as your moderator. I'm extremely excited to introduce our speakers. I have 2 former most influential public fund CEO and CIO, and I have an expert in public policy research with more than 20 years of experience. They will share their insight in how the energy economy will progress and what we should do to win the global competition. Please welcome our speakers, and I will introduce you our first presenter, Mr. Ben Meng. Ben Meng is an Executive Vice President, Chairman of Asia Pacific, and the Executive Sponsor of Sustainability for Franklin Templeton. In this role, Dr. Meng is responsible for expanding firms' investment offerings and client reach in the Asian Pacific region, with a particular focus on leading the private equity, venture capital, and other alternative asset investment capability. Previously, Dr. Meng was CIO, Chief Investment Officer for the California Public Employees Retirement System, CALPUS, and Deputy Chief Investment Officer at the State Administration of Foreign Exchange, SAFE. Please welcome Dr. Meng.
Thank you, Professor Nielsen. Distinguished guests, ladies and gentlemen, good afternoon. As Dr. Nielsen said, I'm Ben Meng. I came from California. It's a great pleasure to be with you this afternoon. I would like to share with you a few thoughts about our global fight against climate change. Many countries, including Korea, has made commitment to net zero. In Korea's example is net zero by 2050. In order to achieve the net zero goals, we need a lot of renewable energy and we need them fast. So basically we need renewable energy at pace and scale to achieve our commitment. As you can see in the chart below, the renewable energy has been steadily rising from 2016 up to now. However, that pace is not good enough. In order to achieve our goal, we need to triple the amount of renewable energy we use. So that requires the adoption of existing renewable energies as well as innovation in new renewable energy technology. Speaking of renewable technology and innovation, there are hope. Technologies such as hydrogen, particularly green hydrogen, and more advanced battery technologies that can pack in more energy intensity, reduce the weight and reduce the risk of fire, also increasing the long duration of the energy storage. In terms of wind energy, we also need larger and more efficient wind turbines. In terms of wind energy, the source wind power as a source of renewable energy, offshore wind power offer promise because offshore wind is more stable, less intermittent, so that it requires less of energy storage capacity. And there are also the latest and the coolest thing is the floating solar photovoltaic technology. And as you can see in the chart list, as recent as only a month ago, India announced that it's going to store the largest floating solar power plant. Having all these great technologies is great. How do we get there? Developing these technologies as well as adopting them requires capital. And as IEA estimated, International Energy Agency estimated, in order for us to achieve our climate goal, which is to limit temperature rise to be 1.5 degree or lower, just in the energy transition sector, between now and 2030, every year we'll need roughly about $5 trillion of investment. Given the high level of the public debt level in the public sector, it is impossible to expect this large amount of capital required to come from the public sector. The bulk of this required capital has to come from private sector. So toward the end of last year, I published an article on Journal of Investment Management, making the case that we were approaching the inflection point of climate investing. But we were approaching the inflection point, but we were not there yet. And in that article, I identified two critical missing pieces. I call them two missing eyes. The first missing eye is information. Investors, in order to bring private capital in the capital market to the table to be part of the solution, investors first need quality climate risk data. I call the investment-grade quality data, so that investors can perform the climate risk and return trade-off analysis, just like what we do every day, that we do financial risk and return trade-off analysis. So we need quality data. That's the first missing eye, information, high-quality information. The second piece of missing eye I identified in the article about a year ago is incentives. We need to give the private sector, investor, the right incentives to come to the table in the form of a carbon tax or carbon pricing. Why is the principle of making the polluters pay does not apply to climate change? So we needed these two pieces of missing eyes. Now fast forward, since the publication of the article, there have been a positive development. I had to say happened even faster than I had expected. So I want to say we're getting really close to or even at the inflection point of climate change now, because there are a positive development on both fronts. First, let's take a look at the first piece of missing eye, information. On March 21st, SEC, the regulator of the largest capital market in the world, rolled out a proposal in making climate risk data disclosure mandatory. And also equally importantly, it adopted or recommended TCFD as the data framework. And this is a boost to the global movement in consolidating different data standards. And also, as I said, that being the regulator of the largest capital market, what SEC does, it has a big ripple effect globally. And as expected, after SEC rolled out the proposal, some other markets, the major markets such as China, started requiring a mandatory climate risk data disclosure as well. And before that, Europe was there already, by and large. So now you have the two largest emitter globally, China and the US, and then one of the largest bloc as well, Europe, are all demanding or mandating climate risk data disclosure, and also they're all recommending the same data format, which is a TCFD. So this is a game changer. So mandatory climate risk disclosure is good for everyone. Obviously, it's good for the regulator and policymakers, so that we'll have a good sense of where we are in terms of our fight against global climate change. It is also good for consumers and customers, so that consumer customers can make their consumption choice based on the climate risk disclosure of the companies, of which the product they are buying from. It is also very good for investors like you and I, so that we can conduct, as I said, that we can conduct climate risk and return trade-off analysis, and we can develop the much needed climate risk analytics tools that we need. So when the proposal first rolled out, ICC had a 60-day public hearing period. And during that period, actually the concerns, most of the concerns, or what you call pushback, came from the companies who are being required to disclose such data. And their common complaint is that it's very complex, it's timely, it's costly to disclose such data. So right after ICC rolled out a proposal, my dear colleague and friend of mine, Ann Simpson, who is also the global head of sustainability at Franklin Templeton, she and I published an op-ed on Financial Times only a few days after the rollout of the proposal in supporting such a proposal and making the case that it is good for the companies as well. For those of you who know Professor George Akerlof, one of his major contributions to modern finance is the theory of information asymmetry. So in this case, if the investors, regulators, or the society at large are demanding companies to disclose such information, and if you choose not to disclose, consumers will assume you are the worst, and they will vote with their wallet by switching their products or their consumption from you to another or to one of your competitors. And similarly, so that will affect your top line revenue. Similarly, investors are demanding such information. And if you do not disclose such information, naturally, investors will assume you have something to hide. And there are some additional layer of uncertainty for investors. And as we all know, if there's additional layer of uncertainty for investors, we demand an additional premium to compensate for such uncertainty. And that additional premium demanded will be reflected on a higher cost of capital for the company. So in that op-ed on Financial Times, we made a case is that the mandatory climate risk data disclosure is good for the companies as well. So information is critical, of course, but it's not sufficient. It is necessary, but not sufficient. We also need the right incentives. As I mentioned that, we need carbon pricing in the form either carbon tax or a cap and trade system. And in that sense, the investor need to know what if I invest in carbon reducing technologies, how much more I can benefit from the amount of carbon reduction. And that benefit, you can capitalize on that benefit or reduction in carbon emission in the carbon pricing market. So on this note, the encouraging news is that on June 21st this year, about 3 months ago, European Parliament adopted a carbon package with one of the 3 components being CBAM. CBAM stands for Carbon Border Adjustment Mechanism. So basically, it is carbon tax at the border. At that time, it was our prediction that even though this is only a policy for Europe, but given how much Europe does business with the rest of the world, it was going to have a ripple effect globally on establishing a global carbon market. That was hand signal for me? Oh, okay. So given 6 more minutes, right, Professor Nielsen? 6 more minutes, sorry. I still have 6 more minutes. I thought I had only 1 minute. I said, wow, I really need to hurry up. Thank you for that. So it is happening now. Think about that. If you are selling goods and services to Europe, such as China and Korea and other countries, now knowing that your good and service will be charged on the carbon tax at the border, European border, you would rather keep the tax revenue onshore to your own country by developing the carbon pricing market at home so that your good and service will be clean by the time that it reaches the European border. So this is happening. Again, this movement is created a great momentum for global carbon pricing market. Climate change is priceless, so we need a price on carbon. And once you have a global carbon market, companies will have the incentive to adopt new technologies, and the consumers will have the incentive to change their lifestyles. And then on top of that, there's an additional kicker, because carbon pricing also generates revenue, and that revenue can be deployed back into developing more green technologies, or distributed back to the society, particularly the part of the society that's most vulnerable to climate change, so that we can ensure our transition to a low carbon economy is a just transition, and we do not inadvertently create climate inequality. So that's carbon pricing can achieve economic, climate, and social goals at the same time. Carbon needs a price because climate change is priceless. With that note, I want to highlight another contribution from two of the giants. One is Benjamin Franklin. One said that make sure that you do well by doing good. The other giant is Adam Smith, the invisible hand that we all know. So here, actually, I look into history. They did have dinner together, and I want to write my next article I'm working on is a history reimagined. Can you imagine if today Adam Smith and Benjamin Franklin sit together, have dinner, what would they be talking about? So we need invisible hand as well as a visible hand. The invisible hand is that you provide the capital market with the tools they need and incentive they need, then the capital market will do what it does the best, which is to allocate capital. And in this case, it's to allocate capital to climate solutions. So that is the invisible hand. But the visible hand is policymaker and regulations, such as we mentioned, SEC proposal in making data disclosure mandatory, and then European Parliament's adoption of the carbon package. So in our global fight against climate change, we need both hands, the invisible hand from Adam Smith and the visible hand, what Benjamin Franklin had been arguing about, doing well by doing good. And now with at the inflection point, I believe that we can do well and do good at the same time if you stay focused on investing in climate technology. That concludes my remarks. Thank you so much.
Dr. Meng suggested and emphasized two things. In a policy perspective, he was suggesting climate risk disclosure, and in the perspective of a private market, he was mentioning about carbon pricing and carbon market. Thank you, Dr. Meng. Our next speaker is Mr. Hee-nam Choi. Hee-nam Choi is a visiting fellow at the Korea Capital Market Institute and an independent external director at the board of Standard Chartered Bank Korea. He was the CEO of Korea Investment Corporation, KIC, since March 2018. He was also chairman of the board at KIC. Prior to joining KIC, Mr. Choi served as executive director at the board of International Monetary Fund, IMF, representing 16 countries in the Asian Pacific region. Mr. Choi brings more than 30 years of experience at Korea's Ministry of Strategy and Finance. Mr. Hee-nam Choi will share his experience and insight in global financial market. Especially, he will address how we can attract foreign direct investment in this very fierce competitive environment. Please welcome Mr. Hee-nam Choi.
Thank you, Professor Nielsen, for your kind introduction. Also with special permission from Professor Nielsen, I'm going to make a presentation in Korean. Okay, today's presentation I will talk about 어떻게 하면 외국인 투자를.
I'm going to talk about how can we attract foreign direct investment in my talk. So I think this is a very perhaps easy question, but it's difficult to solve. So I'm going to talk about what is the current status of Korea and how the financial companies are faring this situation. So in 2021, we have posted a record-breaking $29.5 billion in foreign investment. This is based on approval basis. So this is quite high. So compared to 2020, 2021 saw a rise. And compared to 2019, it's also a rise. So after the pandemic, there had been an increase in foreign investment. However, for this year, in the first half, it recorded $11.09 billion in foreign investment. So, well, in the first quarter, the FDI from the Korean resident to other countries was very high. So there was a lot of outflow. So the Korean companies and Korean investors are aggressively investing overseas. So let's compare the FDI situations globally. So if you see from the graph on this screen, pre-COVID pandemic situations can be compared. In case of Korea, there had been increase in FDI by 34%. But let's look at Japan. It's very interesting. The FDI increased by 80%. So this is a statistics from OECD, and it is based on FDI in 2021. So new investment is new investment minus divestment. So we can see that there is a lot of foreign direct investment in these countries. And the prime case is Japan. So a new for FDI department has been established in Japan, and also the GDP to the balance is 7.4%, and it is planning to raise this ratio to 12%. They are very aggressive in attracting the FDI to Japan. But what about Korea? We are in a difficult situation, but still it is rising. We had Japan's export restrictions, the materials and components, and equipment industries were struggling, but we tried to attract many FDIs, so we could increase the FDIs in equipments, materials, and components. And FDI has increased because of the resilience in the Korean economy. And after the COVID-19 pandemic, Korea has exhibited stable growth. And Korean economy has many advantages, such as in innovation. If we look at the innovation index, according to Bloomberg, Korea was the first, and we are export-oriented. So we can see the global GDP's FDI share is increasing, and a lot of environment for investment is improving. So there was an improved perception on Korea as well, thanks to K-culture, K-pop, K-film. So a lot of interest is in Korea. In the past, there have been negative perceptions on Korea because of the North Korea risk, the geopolitical risk. But since that geopolitical risk has been prolonged for a long time, the investors could see that South Korea can endure the situation. We are showing that strength, and that's the reason why the foreign direct investment is increasing continuously. But we still have to put our efforts to attract foreign direct investment. Compared to other countries, we can see where we are lacking. So we have compared the advanced nations such as USA, Germany, UK, Japan, and France. In terms of infrastructure, we have competitive edge, and in terms of innovation capability, we are on par with the G5 countries. But in terms of tax competitiveness or regulatory competitiveness or market openness, we are lagging behind the G5 by a wide margin. And in terms of tax, the effective corporate tax rate is different. The G5 is 20.5%, but Korea is higher at around 27%. So tax competitiveness is something that we are short on. And in terms of regulatory competitiveness, of course, the index will show different numbers depending on different surveyors and different organizations that take the evaluation. So there may be subjective opinions on this. However, if we look at the regulatory environment index, Korea is showing very low numbers. And in terms of FDI regulatory index, Korea is perceived to be very much regulated. And in terms of market openness, well, this is a data from Heritage Foundation. Compared to the G5, we are showing very low level, and it's very close to Japan's figures. And in terms of financial freedom, Korea is posting very low numbers and very similar to that of Japan. So far, we have seen the numbers of FDI. Now, let's look at the financial institutions, the status of foreign financial institutions entering Korea. There have been many efforts to attract these foreign financial institutions. According to the GFCI, Global Financial Center Index, Korea is ranking this much. Hong Kong, Shanghai, Singapore, Tokyo is continuing to be one of the top 10s. Seoul is rising, but still out of the top 10. So in terms of entry of foreign financial institutions, I have compared the numbers, and this is the sources from FSS, and you can see that not a lot of foreign financial institutions are coming to Korea. In terms of banking, the number is gradually dropping, and we can see a rise in financial investment. Well, asset management companies or private equity may be examples of financial investment, and we can see that these organizations are entering into the Korean market. But overall, the graph is flat. So why is this occurring? Since 2003, Korea has pursued the Northeast Asian financial hub strategy, but this hasn't translated into a clear result. But we can see it from the other side. We have fintech and a great infrastructure for finance. So we have a great financial infrastructure in place, but in terms of financial regulation and labor issues and tax issues are not faring well compared to the advanced nations. And also, there are always some bias and bias perception on financial institutions. They say that they are running away by taking profits. And the recent example is the Lone Star verdict. So maybe we have prejudice against foreign financial institutions. And we have always pursued the financial center strategy, but recently we are seeing changing conditions. First is working from home or telecommuting trend. And some financial institutions would like to move out to suburban areas instead of clustering in the financial hubs. And globally, after Brexit, many financial institutions are moving away from London to the European continent, and in Hong Kong as well. They are suffering from zero COVID policy and national security law. So the key talents are moving away from Hong Kong to Singapore. So these are some of the things that we have to consider, because after the COVID-19, this has been globalization, which had been the norm, is translating and transforming into fragmentation trend. So we have to consider these in our new financial center strategy. So we have to rethink the financial center strategy. We have to shift away from the traditional strategy to a new strategy. The asset managers, which are playing the role of GPs, are moving from New York to Florida because of low state income tax benefits and advancements in digital technology. They don't have to stay in New York to operate. And also, due to Brexit, institutions are moving from London to Paris, Frankfurt, Dublin, and Amsterdam. So then, what does that mean for us? So in terms of policymakers, they need to come up with a new financial model. In this government, regulatory reform is one of the national priorities. And there are lots of efforts to reform the regulatory environment. And the digital transformation has to be well leveraged by financial companies. And we're seeing fintech companies playing a role in the financial market. So we have to support the fintech companies and create a fintech hubs in certain locations. The Busan city is trying to create a digital hub based on blockchain. I believe that Senior Research Fellow Yoon-suk Lee will be talking about this. And I think we need to promote a sustainable, eco-friendly financing hub. We tried to create a hub where all financial centers could cluster in. But then we have to think about a regional specific specialized financial hub. I think that's the more important and effective direction. With this, I would like to end my talk. Thank you very much.
Capital to invest in a strategic field. We can see that technology and energy, especially, is under really fierce competition in the global market. We all agree that we need both advanced technology and finance to support it. Our next speaker is Yoon-Suk Lee. Yoon-Suk Lee is currently a senior research fellow of the Innovative Finance Research Division and director of the Center for International Financial Cooperation at the Korea Institute of Finance. The institute is the most prominent institution in Korea that is specialized in financial research. Dr. Lee began his career in the financial sector at the Bank of Korea, where he worked as a portfolio manager in the Reserve Management Office. He published numerous papers and also received several public awards, including the Civil Merit Medal in 2021, Minister's Commendation in 2020 and 2015. Please welcome Dr. Yoon-Suk Lee.
Thank you, Jeonju, for your warm introduction. It's probably one of the nicest introductions I've listened to in my career, so I very much thank you. And originally I was intended to speak in English, but then, you know, Bernie and Brent, you were away from this podium for a second, so only Ben was here, so I quickly thought of changing my presentation to Korean, but then you re-entered this room, so now I'm more privileged to speak in English again, so forgive. I want to tell you to all the Korean audience here to forgive me for speaking in English. I also want to thank the Jeollabuk-do and the city of Jeonju, the MPS, and also the staff at Saemangum Management Agency for the wonderful tour that I personally very much enjoyed and was very interesting in terms of how the Saemangum project has evolved over the 30 years, which was probably also inspiring to other participants who were there yesterday. And also, before I start my talk, I just want to give you a small sort of, story about my relationship with Jeonju. In Korea, not all the family names are originated from the same city. So my family name is Lee, and I am in Korean so-called Jeonju Ishi, which means my ancestors who found the family name Lee originated our sort of, family in Jeonju. So, as you know, Jeonju Ishi, they created the Joseon dynasty back in late 14th century. So me and Jeonju have like more than 500 years of history, just to let you know. So that was like, the ice-breaking comment that I wanted to make. Now I'll move on to my presentation. So I'm going to talk about energy and the role of regional finance. How are they related? They might seem a bit remote, but the sort of connecting points, I think, is sustainability. And why should we care about sustainability in the first place? Well, it's pretty obvious. We need that for the survival of mankind. And for that, we need a holistic approach and not a fragmented one. So then we can think about the role that regional finance can play in sustainability. And probably the first thing that comes into mind would be providing financial incentives to enforce sustainability. But then, from my personal view, I don't think this is sufficient enough. So in the long run, I think we have to look for more incentive compatible approaches because, financial incentives are important, but then we have to come up with the schemes that are incentive compatible, which can be, say, enforced in the longer run. So I think achieving energy sustainability in the financial sector is probably one of the important themes and issues that we have to look into. Related to that would be the kind of things that we've been seeing during the past, a little bit over 2.5 years during the pandemic era, where we've been seeing remote working and financial digitalization, and that sort of, resulted in a probably, unpredicted way carbon reduction during the process. So that is one area that we can, in terms of the direction of where the financial sector can connect with sustainability. Another aspect would be energy conserving cryptocurrencies. The reason why I bring this up is because we've seen a rapid expansion of cryptocurrencies and transactions related to decentralized finance. But one of the problems about cryptocurrencies related to energy consumption is that for the case of Bitcoin, Bitcoin is actually very much energy consuming cryptocurrency, because we've been hearing stories that in order to mine Bitcoin on a yearly basis, it actually consumes more energy than, I was told Finland consumes in a year. So unless we sort of tackle that issue and make it a more sustainable way of creating these or mining these cryptocurrencies, I think it's definitely going to be an issue that people would not neglect in the future. Another thing that we can relate regional finance or financial issues with energy is the area of risk management. I know that during the short presentation that was shown by Carlyle Group early on, they were talking about basically energy transition and energy security. They are all related to risk management. So, without saying much of the details related to climate crisis, we're already seeing things around us. For the case of Korea, we experienced heavy rainfall in the early part of August, and this is like the, probably most representative picture depicting a person who is sitting on top of his car due to heavy rainfall. And on the right-hand side, you're seeing a relic several centuries ago, is what we call the hunger stone. So this was like a stone that was, probably carved several centuries ago, but only was revealed during the long periods of drought in the summer, long periods of summer this year. So, these kind of extraordinary events and phenomena are becoming more and more evident these days. So, why do we need, or why do we have to think about balanced development? How does this relate to, the importance of regional finance? I first want to stress the risk related to concentration. Here you're seeing the trend of population proportion comparing the capital area versus the local area in Korea. And as you can see, even in the late 1940s, the capital region proportion of the total population only amounted to a little over 20%. That actually gradually increased, and now it's more than 53%, almost 54%. I'm sorry, in the year of 2020, it's a little over 52%. And I think the important thing that you want to keep in mind in this trend is that the population of the capital area is actually increasing, even though we have been striving this balanced growth policy or strategy for several years now. So I think just from the point of population concentration, it's critical. Another aspect would be the polarization of regional growth in addition to the population concentration that I've just shown you. And as you can see here, if you compare the capital region versus the local areas, the difference is growing instead of narrowing. So I think these two graphical presentations gives you a rationale behind why balanced growth between capital and non-capital areas is important. Because as we've seen in previous academic studies, polarization of growth limits the growth potential in a very serious process, as you might want to put it. So now, if we think about Jeonbuk Innovation City and how that, as we call it, the financial hub initiative, when we think about financial hub or a financial center, I don't think it's just about bringing in financial companies. It's actually a way of living or a place where you should feel like residing with your family, for instance. So instead of just trying to focus on trying to bring in more financial companies, international financial companies, I think the case of, say, Miami is a good example, and that has been touched upon by Dr. Che in the previous presentation. We're seeing like some of the New York-based companies moving to Florida, cities like Miami. Why is that? Several reasons. Financial incentives, but I think in addition to that, people are starting to wonder, why should we live or do business in New York in the first place? And probably pandemic is one of them. Second of all, the culture of the workforce is changing. The way of work is changing. Working can be done in a digitalized way. So I think overall, various factors are bringing in those kind of, fundamental changes. A second aspect that I want to stress is public support is needed in the initial stages of a financial hub initiative. But at the same time, Jeonbuk or Jeonju should not be wholly dependent on public support. Because I think in the past 5 or 10 years, Jeonbuk has proven that it can become a potentially financial hub initiative in terms of, the difference that it has shown in the past years. And actually, after visiting Saemangeum yesterday, I think, the sort of missing puzzle, I'm probably going to show you a slide that is connected with that in the following minutes, but I think Saemangeum can be one of the factors that can contribute to the financial hub initiative. Third, I want to stress also the importance of balancing outbound versus inbound policies. Because if you look at the example of K-pop, for instance, various Korean artists have been knocking the doors of the US, European countries, Southeast Asian countries before they were actually, well-renowned. So before BTS or Blackpink, there have been, 10, 20 years of relatively low exposure to the Western countries. So probably, Psy was probably one of the major breakthroughs that K-pop went through before BTS and Blackpink. So I think in order for Jeonju or other actually financial hub companies, for instance, Seoul or Busan including, I think we have to go to cities like New York, London, or Singapore or Hong Kong to actually prove that Korean financial services and Korean financial companies are competitive in terms of the quality. And after that, I think probably it will be natural for foreign financial companies to come to areas such like Jeonju or Seoul or Busan or any other place for that matter. Again, I want to stress the importance of balancing the real sector together with the financial sector. So if you look at historical financial hubs, no financial hub has been able to thrive on its own. New York, London, Singapore, Hong Kong, all had real economies behind the thrive of their financial success. So I think, the Saemangum project is probably one of the key factors that Jeonju or the Jeonbuk mega cluster can actually combine their competitiveness in the future. Because as you see in the next slide, there are actually several public institutions that are related to the agricultural and bio industry. And I think these public institutions can play a very crucial role in trying to promote the real economy surrounding the greater Jeonbuk area. In addition, there are also other public institutions, such as National Pension Service, for obviously. We also have the Electrical Safety Corporation, which also deals with the energy-related policies. So I think with these very well-established public institutions, I think Jeonbuk or Jeonju should make the most out of these public institutions and try to relate them to promoting the financial hub initiative. Lastly, I want to touch upon self-sustaining system. Obviously, probably most of you are well aware of the carbon footprint. So regional development contributes to carbon reduction by creating lower incentive to concentrate. So for instance, one less long-haul flight per year contributes to 1.68 tons of average reduction per person, which is quite a huge amount if you aggregate those numbers on a national level. So we should note that decentralization can mitigate the negative effects of concentration risk. And I think in that aspect, Jeonbuk Innovation City has great potential for self-sustainability because we've seen solar panels in Saemangum, and also there are going to be wind power in the future that they're aiming for. So I think all in all, Jeonbuk Innovation City can provide as a good example for a self-sustainable financial hub as a representative for Korea's financial hub policy. The last slide is just a representation of the energy flow in Korea. Only 8.9% comes from hydro and renewable sources. So I think Saemangum can contribute to enlarging that proportion to well over the 10% level, and probably that can contribute to a much more diversified energy source that can contribute to the sustainability of the overall economy. Okay. Thank you. I will end my talk here. Thank you for your listening.
Thank you, Dr. Jeonju Lee. Now, I'd like to ask some questions on behalf of our audience. Ben, you emphasized regulatory requirement and carbon market. Do you think those two can help green hydrogen ecosystem here in Jeollabuk-do?
Yes. So green hydrogen, actually, when you think about the transition to low carbon economy, renewable energy, such as wind and solar, needs a partner. The reason renewable energy needs a partner is the intermittent nature of renewable energy. When there's no sun shining or wind blowing, there's no renewable energy. And also, when there are a lot of renewable energy, you cannot consume them. You cannot store them. So the key now is energy storage. The leading technology now is the lithium-ion battery. But lithium-ion battery playing the role as a partner, but not a very good partner so far. Green hydrogen can be that solution. Because if you think about green hydrogen, it's basically you pack renewable energy in a bottle and then you ship that bottle to wherever you need renewable energy. You open up the bottle, release the renewable energy. I'm using metaphor. So basically hydrogen, in order to create hydrogen from water, you need energy to break up the bond. And that energy, for example, say in Australia, has abundance of renewable energy. As July, I was in Singapore. I was in conversation with a number of policymakers and key investors. And they were asking me, and also I was interviewed by Straits Times, and they were asking me what I think of the proposed plan of the undersea pipeline to get natural gas from Australia to Singapore. Because the ongoing war really shook many countries, such as Singapore, to the core about two national security concerns, energy security and food security. And Singapore does not have neither. So that's Singapore is contemplating on building that natural gas undersea pipeline. And my first reaction is that it's going to be very costly and going to be also very expensive to maintain. And more importantly, by the end of the day, it's still fossil fuel. So my recommendation was really to use Singapore hydrogen, even though it's not there yet. But I believe in human ingenuity. If there's a need, if there's a desire, we put enough behind human capital and financial capital behind it, renewable hydrogen, blue hydrogen will get there. So the idea is use renewable energy Australia to break up the bond, to create hydrogen, put the hydrogen metaphorically in a bottle, ship it to Singapore, then you burn the hydrogen, and the beauty or the benefit of hydrogen is that the byproduct of your released energy is water. Because in hydrogen, that chemical reaction, there's no carbon in it. So how to make that happen? Again, needs regulation, just like carbon pricing. You need, if the carbon price is high enough, naturally the capital will be directed to green energy, green hydrogen development.
Thank you. I'd like to ask Mr. Hinam Che, and especially Mr. Ben Meng mentioned about Singapore. And it seems like Singapore is taking advantage of Hong Kong's situation. So Mr. Che, is there any way that we can actually take that back? Or do things a little bit differently?
I think that is not an easy task. As far as I'm concerned, some financial institutions, they did kind of, reallocation of their staff, not actually relocation of their company to Singapore. So I know that Hong Kong play a very key role as ECM business hub. So they are still looking for some business opportunities of the Chinese companies. So it's very difficult to relocate their office from Hong Kong to Singapore. But temporarily, the business environment and living conditions are a little bit deteriorated. So they want to relocate some of their staff to Singapore. But as I mentioned, Singapore has they have a very good comparative advantage in various terms. Their business environment is very excellent, and also their focus is they adopted very focused approach. So they try to be the hub of the I can say the kind of trading. I mean the FX trading or asset management, fintech, rather than whole business area. So nowadays Singapore became I realized that Singapore became the hub of the financial hub of Asia. So I think Ben, you might have some idea compared to Hong Kong and Singapore.
I would just comment on Singapore. Singapore is really a fascinating country. Think about Singapore, really, it doesn't have anything other than a deep sea port. But Singapore somehow really commands a seat on the global stage. Almost every month, I have an invitation to go to Singapore for some conference. For example, now after this trip, I go to Singapore again for Milken. And then October is the PPI, the Pacific Pension Institute annual conference. And then in November is the GIC Summit and then Bloomberg New Economy. So Singapore somehow really figured out a way to create create a financial hub for itself, almost out of nothing, or almost literally out of nothing. I have not studied a lot. I don't know exactly how they achieved it, but I think Korea truly has the potential to be a very strong competitor of Singapore, become another financial hub in Asia.
Yeah.
Thank you. Oh, I'm sorry.
It's been mentioned that Singapore they host conference every day actually, and I understand next week Singapore hosts Milken Conference, Asia Summit, back-to-back Formula One events. They try to host all participants from the world.
And this is only on the finance side. They have the Shangri-La dialogue. Singapore, and also just look at Singapore during the pandemic. Singapore played the pandemic. When I say played in a very good way, their policy is almost pitch perfect, totally science-based, fact-based, and also Singapore country, the people, they have a very high level trust of the government. They listen to their government because the government is science-based and fact-based, right? So the population really collaborated with the government and every step along the way. So now Singapore, because of the geopolitical tensions and other factors, there is a large exit of wealth as well as talent from many other parts of Asian countries, namely China, Hong Kong, Taiwan. Where did they go? Most of them went to Singapore, not just the wealth and also the talent. And I think it's a really good case study. I know the pandemic is not over yet, but I think it's a really good case study for Korean government or for any other government to study how Singapore performed during the pandemic.
Thank you. I think, Dr. Bang, you should come here more often than Singapore. That might be the very first step here.
So it's ongoing joke in my family. I still think I'm part of Korean. I keep on asking my mom. My mom said, no, you're not. If you were, I would know.
My next question is to Dr. Yoon-seok Lee. Over the past few years, I see really a lot of investment in agriculture and energy from big real money. Do you think we actually have that capacity here to attract foreign investment, foreign direct investment?
I'm not an expert in the area of energy or agriculture, but I think one thing that I could, comment on your question is, I think the Jeonbuk area has a lot of potential in that area. So, for instance, I've been showing in my presentation the various public institutions related to agriculture and the bio industry. So obviously, it is an area where research and government policy can be implemented in terms of experimenting different kinds of technologies related to, say, smart farming or digital farming. I can't go into the details that much, but obviously it's an area where future investment obviously would be a great potential for that. In addition, I also want to point that, after seeing Saemangam yesterday, Saemangam also, originally actually Saemangam, I learned 30 years ago when it was first initiated, the government was aiming for 100% of Saemangam turning into farming areas. So agricultural use was 100% intentional use for the Saemangam. Now that has changed to only 30%, and then the remaining 70% is for multi-purpose uses such as industrial or research or tourism, or actually even residing residential purposes. So as time evolves, things have been changing, but still there are 30% of the area that is reserved for agricultural use. I don't know how much of that is going to be realized in terms of actual attractive investment, but I think one of the areas that I want to point out is the relationship with North Korea. And the reason why I bring that up is because if there is a chance for the South and the North to cooperate economically, so it could be in the near future, it could be several decades from now, I don't know. But I think Saemangam is an area where North Korea's cheap labor and agricultural advanced technology by the South can combine, and they can create an agricultural complex or even an industrial complex. So I think it's an area that we can potentially look for future development whenever that happens. Thank you.
Thank you very much. It seems like two things are very obvious to me. The first, the energy industry is definitely changing, and we have to keep the pace for it. And definitely, to be outstanding and to deliver outstanding result here, we need to attract more capital. We need a direct investment. Am I right? It is a real true honor for me to serve as your moderator. And today, I really want you to have Mr. Ben Mang here from California. Just like we are hoping to invite a lot of guests from everywhere in this planet. And thank you very much, all of you. And thank you for joining our session today. Thank you.
So that brings us to the end of session 2 of Jeonbuk International Finance Conference 2022. We would like to sincerely thank all of our distinguished moderators, including Professor Sam-Young Chung from the Graduate School of Information at Yonsei University, as well as Professor Young-Jun Nielsen from the Graduate School of Business at Sungkyunkwan University. And we also would love to thank all of our eloquent panelists whose expertise and in-depth knowledge enabled us to enjoy fruitful discussions and passionate and constructive debates. Thank you so much. So before we let them go, ladies and gentlemen, please give them a final round of big applause. Thank you. So with that, we will officially conclude the Jeonbuk International Finance Conference 2022. We would like to express our heartfelt appreciation to all of our attendees once again for gracing the occasion with your presence today, despite your busy schedule. We sincerely hope to see you again next year with much better programs. And finally, we would like to especially thank all of our online attendees who have kindly stayed with us until the very end of our programs today. Thank you so much for tuning in, and have a great day. if you're joining us from the other side of the planet, or have a great evening if you're joining us here in Asia. Thank you.